Hello everyone. So welcome to EduTap and welcome to today's weekend marathon session that we are conducting for the RBI Grade B 2026 Phase 1 examination. And today is your marathon session for the RBI notifications and RBI press releases. So today we are going to discuss the MCQs from the top 30 RBI notifications and RBI press releases. Okay, so I hope you all are ready for this session as it is going to be very helpful for all of you if you are preparing for the RBI Grade B 2026 Phase 1 examination. So first of all, give me a thumbs up if I'm clearly audible and visible and everything is fine. Okay, so now let's get started with today's session and I will be providing you the MCQs. First, we will discuss the MCQs from the May RBI notifications and press releases. Then we will discuss the MCQs from the April, then from March. And I've also brought some MCQs from the most important RBI notifications and press releases of Jan and Feb. Especially if we talk about the internal ombudsman scheme or internal ombudsman directions, the priority sector lending directions, so that are very important. So from there also I have brought some questions. Okay, so this session is going to be focused on the most important RBI notifications and RBI press releases and the important data point that you have to remember from the examination point of view. So good morning, everyone. Okay, let's start. So this is the first question and I hope you will be easily able to answer this question. Okay, so we are going to start with the MCQs from May 1st. Okay, we are starting with the MCQs from May. With reference to the financial eligibility and operational requirements prescribed under the Foreign Exchange Management Authorized Persons Regulations 2026, consider the following statements. A multi-branch, full-fledged money changer, a multi-branch FFMC is required to maintain minimum net own fund of 50 lakh. Absolutely correct. The single branch FFMC is required to maintain the net own funds of 25 lakh. Okay. Now, authorized dealer category 2 entities are required to maintain a minimum annual forex turnover of 75 crore. This is not correct because the authorized dealer category 2 entities, they are required to maintain a minimum annual forex turnover of 50 crore. Okay, so this is incorrect. FFMCs are required to achieve and maintain minimum annual forex turnover of 10 crore. So this is correct that the FFMCs, they are required to achieve and maintain the minimum annual forex turnover of 10 crore. Okay, so here the first and third statements are correct. The second is incorrect, and that's why the right answer here is 1 and 3. 1 and 3. Okay. So basically, this authorized person's directions we have also discussed in the Finance 360-degree session, where I discussed with you that the single branch FFMC needs to have the minimum net own fund of 25 lakh, multi-branch needs to have the 50 lakh of minimum net own fund. Then we discussed about the net worth criteria: 25 lakh for single branch, 50 lakh for multi-branch FFMC, 10 crore for the authorized dealer category 2 and 2 crore for the authorized dealer category 3. Okay, then we also discussed the minimum annual forex turnover that is required by the authorized dealer category 2, that is 50 crores, and for the FFMC it is 10 crores, and this has to be achieved within 2 years from the date of coming into force of these directions, or from the commencement of forex business, whichever is later. Now try to answer this question. The forex correspondent framework under the Foreign Exchange Management Authorized Persons Regulations 2026 permits appointment of forex correspondents by which category of authorized persons? So which category of authorized persons can have the forex correspondents? Which category can have the forex correspondents? FFMC is the full-fledged money changer. They can do the money changing activities. That means they are allowed to sell and buy the foreign exchange. Okay, they are allowed to sell and buy the foreign exchange for certain activities only. I have taken a detailed session on the authorized person directions, so do see that session because it is important that what the FFMC do, what the authorized dealer category 1, category 2, category 3 are allowed to do. So foreign full-fledged money changer, they buy and sell the foreign exchange from the travelers and such. Now, the Forex correspondent framework under the Foreign Exchange Management Authorized Person Regulation 2026 permits appointment of Forex correspondents by which category of authorized persons? By authorized dealer category 1 and authorized dealer category 2. Okay. So these are the categories that can have the Forex correspondents. So foreign exchange correspondent can be hired by the authorized dealer category 1 and category 2. So forex correspondent is basically the agent that is hired by the authorized dealer category 1 and authorized dealer category 2. So the full-fledged money changers, they are able to do, right now they are able to do such kind of activities. They are able to purchase the foreign currency or notes or coins and the traveler's check from the travelers. They are able to sell the foreign currency, notes, coins, traveler's check for the foreign travel purposes. They are able to get the internal remittances. They are able to get the internal remittances. Now it has been said that the full-fledged money changer, they will not, like the new entities, they will not get the authorization as the FFMC. Okay, from the date of the regulation, if there is any new application that is coming from a new entity to become the FFMC, so they will not be allowed to become the FFMC. Rather than that, there is the Forex correspondent scheme that has been launched, and under this Forex correspondent scheme, the authorized dealer category 1 and category 2, they can have the Forex correspondents as their agents. They will be able to perform the same functionalities as the FFMC. That is the idea. Now, the functioning of foreign exchange correspondent, they act as the agent they can act as the agent to more than one authorized dealer. The forex exchange correspondent, with the approval of its principal, they can deal in the foreign exchange with any other forex correspondent or an authorized person which is not the principal. Okay, that is the basic idea, and the rest you can read. Franchisee of the authorized persons, it is not allowed now. It has been said that the authorized persons, they cannot give out the franchisees. They can only have the foreign exchange correspondent. That is basically the agent. Of the principal authorized dealer category 1 or the authorized dealer category 2. Okay, so authorized dealer category 1 or the authorized dealer category 2, that is hiring the forex correspondent, is the principal, and the forex correspondent will be the agent. That is the idea. Now, moving forward with the next question. Following the RBI's amendment directions issued in May 2026 on inclusion of quarterly profits in common equity tier 1 capital for the computation of the CRAR, which of the following categories of banks are now allowed to reckon current year profits for the CRAR calculation on a quarterly basis? So basically, we have recently discussed this in the Finance 360-degree session, that the quarterly profits, they will be allowed to be included in the common equity tier 1 capital. They will be allowed to be included in the common equity tier 1 capital. Okay, so in the common equity tier 1 capital, this is the most liquid capital that the bank has. Just give me a second. So this is the most liquid capital that the bank has. Okay, so in this common equity tier 1 capital, the bank adds the retained profits that is earned in the previous financial year, the paid up equity share capital, that is the capital that is provided by the shareholders, that is added in the common equity tier 1 capital. So the common equity tier 1 capital is the most liquid capital that the banks have. Now it has been said that on the quarterly basis, the profits can be added in the common equity tier 1 capital. The retained earnings can be added in the common equity tier 1 capital on the quarterly basis. For which category of banks? For commercial bank, small finance bank, for the payment bank. For these three categories. And that's why the right answer is B here. Very good, Kashish. Very good. Anshika, Abhi, absolutely correct. Okay. So this is the idea. B is the right answer. And it has been said that the net profit, that is the profit after tax, the profit that is left after paying the tax for the quarter, from the net profit, deduct the average dividend of dash years. Deduct the 0.25 multiplied by the average dividend of how many years? Average dividend of past 3 years, So we will come at the eligible profit of the quarter that can be added to the common equity tier 1 capital. So in the common equity tier 1 capital, see, the profit is divided into three parts. The profit has to be paid from the profit, tax has to be paid. Then the dividends have to be paid from the profit, and whatever is left is the retained earnings. It is the undistributed profit that the firm is keeping with itself, that the bank is keeping with itself for the future operations and the expansion. So basically, profit after tax, after paying the tax, then we have to deduct the dividend that is taken as 0.25 multiplied by the average dividend of the past 3 years. So after the dividend has been deducted from the net profit, from the profit after tax, when the dividend has been deducted, then we are left with the retained earnings, that is the eligible profit of the quarter that can be added in the common equity tier 1 capital for the commercial bank, small finance bank and payment bank. Okay. Now, this is all that we have already discussed. I've also provided you the formula that eligible profit for the quarter is the net profit of the quarter. The net profit, that is basically the profit after tax of the quarter, deducting 0.25 of the average dividend paid during the last 3 financial year. Okay. So average dividend paid during the last 3 financial year. While calculating the common equity tier 1 capital for the relevant quarter, cumulative net losses up to the quarter end must be fully deducted. This is the idea. Now coming to the next question, try to answer this question. As per the Reserve Bank of India Commercial Bank's Responsible Business Conduct Amendment Directions 2026, if a calamity has been officially declared in an area, a bank may, at its discretion, provide relief measures such as waiver or reduction of fees and charges for customers in that affected area for a period not exceeding how many days or how many months. So try to answer this question. This is an article from your recent months, and see, there are certain articles that we have not discussed in the Finance 360-degree session. So I've brought the questions from those articles also in this particular session. So through the questions, through the explanation, we will discuss that particular article. Okay. So here, anyone knows the answer? Okay, B is not the answer here. C is the answer. 12 months. So basically, RBI has issued the Reserve Bank of India Commercial Bank's Responsible Business Conduct Amendment Directions 2026 to align it with the Reserve Bank of India Commercial Bank Resolution of Stressed Assets. So what has happened that these banks, commercial banks, small finance bank, local area bank, urban cooperative bank, RRBs, rural cooperative banks, that is the state cooperative bank, the state cooperative bank and the district central cooperative bank, NBFCs, and all India financial institutions, it has been said to them that if there is a calamity that has been officially declared in an area, a bank may at its discretion provide relief measures such as waiver or reduction of fees or charges for customers in that affected area for a period not exceeding 1 year, that is a period not exceeding 12 months. Okay. If persons are displaced or adversely affected by a calamity and unable to access their identification or personal records, let's say there is a flood that has come or earthquake that has come, or there is some cyclone or typhoon, because of that the people have been displaced, they are not able to access their identification or personal records, so bank can open small accounts for such kind of people. As per the KYC direction 2025, if an individual wants to open a bank account, the person can open the bank account, that is the small account, without the KYC documents for a certain period of time. But the small account has limitations. That is the aggregate, the total credits that can come in the small account in a financial year does not exceed rupees 1 lakh. The aggregate total of all withdrawals and transfers in a month does not exceed 10,000, and the balance at any point of time does not exceed 50,000. So these are certain limitations. So basically what has happened that the banks can provide waivers or reduction of fees and charges for customers that are from the affected area of the calamity for a period not exceeding 12 months, and the small accounts can be opened by the banks for such kind of people. If a bank's branch is affected by a calamity, it may operate from a temporary premises after informing the concerned regional office for a period of 30 days only. Okay. Now coming to the next question, consider the following statements with reference to the Reserve Bank of India Commercial Bank Resolution of Stressed Asset Second Amendment Directions 2026. So these directions are also regarding the calamity only. Okay, there are three or four directions that the RBI has released regarding the calamity, but the most important points we are discussing here, and I'm also showing you the questions. So consider the following statements with reference to the RBI Commercial Bank's Resolution of Stressed Assets, Directions 2026. So borrowers whose accounts are classified as standard and they are not in default for more than 30 days as on the date of occurrence of the calamity or date of declaration of the calamity, they are eligible for resolution plan. So basically, standard asset, what are standard asset? That are the loans that the banks have provided and the assets have not converted into non-performing asset. That means for more than 90 days, the repayment has not stopped for more than 90 days. Okay, so the assets have not converted into NPA. So the asset is standard asset, the loan is standard, and not in default for more than 30 days, only within 45 days from the date of declaration of the calamity that the resolution process can be invoked. This is also correct, that within 45 days from the declaration of the calamity, the resolution process can be invoked. It's not like that 2 years back the calamity happened and now you're taking the benefit. No, within 45 days of the declaration of the calamity, the resolution process can be invoked, and the resolution plan for the borrowers affected by the calamity must be completed within 135 days. So this is incorrect. So here the right, yes, the right answer is 1 and 2. So here A is the answer. Okay. So if you have not studied these direction, do not worry about it. We will discuss the direction now. And here you have to tell the incorrect statement. So 3 is the answer. 3 is the answer here. Okay. So it happens with me that I usually do not read incorrect or correct, but you have to remember in the examination to be very, very careful. Okay. So this is a fault from my side, that usually when I am reading the questions, I do not focus on the incorrect or correct. That's why in the examination, you have to be very, very sure if you also have this kind of problem. So be very sure that you are seeing that the correct or incorrect, what is being asked. Then only you will be able to answer the right. Then only you will be able to mark the right answer. Okay. So E is the right answer here because only 3 is the incorrect statement. So basically, as part of the regulatory rationalization for borrowers that are impacted by the natural calamities or external disturbances such as the riots in the area, RBI has now introduced a new chapter on the resolution of accounts impacted by calamities. And the enforcement of the direction is from July 2026. So all the directions regarding the calamity, they are going to be enforced from July 2026, and for the same category of banks and for the same category of NBFCs and All India Financial Institution. Now, if a calamity affects a larger part of the state or union territory, the responsibility to coordinate the relief related banking measures lies with the state level bankers committee or union territory levels banker committee convener bank, that is the coordinator bank. Accordingly, after official declaration of the calamity should be officially declared. It's not like that in only a small area there is a pothole, because of that the calamity has been the calamity has been considered by the people around. No, the calamity should be declared by the authority, by the state or by the union territory authority or by the district authority. The calamity should have been declared. Okay. So when the authority is declaring the calamity, then only the disaster will be considered the calamity. So basically, accordingly, after official declaration of the calamity, the convener bank must convene a special state level bankers committee meeting or the union territory level banker committee meeting within 15 days from the date of declaration of the calamity. Okay? If the calamity affects only a part of the state or union territory, the responsibility shifts to the district consultative committee, convener bank of the affected districts. They have to do the meeting within 15 days, and after the 15 days meeting should happen within 15 days, and after the meeting that has happened like within 15 days, there will be resolution plan, the implementation of resolution plan. So resolution plan will only be provided, the resolution plan will only be provided to such borrowers that have the standard accounts. That means the account has not become NPA, and the eligible borrowers are such borrowers which are not in default for more than 30 days. So these are the borrowers for which resolution plan will happen in the area of calamity. Now, date of so invocation within 45 days of declaration. That means plan the resolution plan should be invoked, should be prepared within 45 days of the declaration of the calamity, and the implementation should finish within 135 days. Okay. So invocation of the plan should happen, or the resolution should be invoked within 45 days of the declaration, and implementation of the resolution should be within 135 days. This is all that you have to study here from this article. The rest of the details have been provided in the diagram so that you can read. But this is the idea. Any confusion here? Any confusion? Now coming to the next question. So this is also linked to the above only regarding the calamity. Regarding the calamity. Now, as we have studied that they the banks they have to provide some relief measure to the borrowers that are affected by the calamity that is declared by the authority. Okay. So now if the banks are providing the resolution plan to the borrowers. That means the banks are providing moratorium period for certain period. The repayments will not be done by the borrower, or let's say for the timeline of the loan has been extended and such. So if bank are providing the resolution for the borrowers, in this case the resolution plan, if the banks are providing for the borrowers, the banks also need to maintain certain additional provisions. What are those additional provisions that have to be maintained in addition to the normal provisions? So, under the Reserve Bank of India Income Recognition Asset Classification Provisioning Amendment Directions 2026, banks restructuring loans of borrowers that are affected by the officially declared calamities, they are required. So, banks are required to maintain what level of additional provisioning? Think about it. What can be the percentage? Take a guess if you are not aware about it. Very good. 5% is the answer. 5% of outstanding debt in addition to the normal prudential provisions. Okay. See, whenever you are answering the questions, if you are not aware, leave it, because then the risk is very high. The probability is only 20% that you will answer the question correctly. But let's say your subconscious mind has is hinting to you that you have studied it and you are confused between two options, then the probability is 50-50%, so you should take that chance. Okay, so remember that through the multiple MCQs, you are training your brain for the elimination method, for the elimination process. So your subconscious mind also becomes aware and more active. Okay, so attempt a lot of questions so that you train your mind, your subconscious mind becomes active, and you know about the elimination method. Okay, so B is the right answer here. So again, RBI has further issued a consequent amendment, that is for the asset classification provisioning and such. Here it has been said that if a resolution plan is implemented by the bank under the RBI rules for the borrowers affected by calamities, then accounts that are already classified as standard can continue to remain in the category of standard after the resolution plan is implemented. If any borrower account had become NPA after the calamity, but before the resolution plan was implemented, so after the calamity, the borrower has become NPA, but before the resolution plan was implemented. So in this case, because of the calamity, the borrower has become the NPA. So in this case, if any borrower account has become NPA after the calamity but before the resolution plan was implemented, then such account will be upgraded back to the standard status once the resolution plan is put into effect. Okay, a bank shall make an additional specific provision. So what is the specific provision that is required? So specific provision of 5%. Okay, so basically whenever the bank is providing the resolution plan for a borrower that is affected by the calamity, there is the additional provision of what percentage that has to be maintained? There is additional provision of 5% that has to be maintained. In addition, this is in addition to the normal provisions. So in addition to the normal provisions, in addition to the prudential provisions, in addition to the normal provisions, there is additional specific provision of 5% that has to be maintained for the borrowers that are under the resolution plan. But the total provisions, the normal provisions plus the additional provisions, the total provisions cannot exceed 100% of the loan. Okay, so the provisions are subject to a ceiling of 100%. So prudential provisions and the additional 5% provisions, they are subject to the ceiling of 100%. Okay, so if prudential provisions are 98%, so can the additional provisions be 5% now? No, no. Okay, so if the prudential provisions are 98%, the additional provisions cannot be 5% because the ceiling is 100%. Okay, so additional provisions are 5%, but uh, the total provisions cannot exceed 100%. If a borrower's account requires repeated restructuring due to continued impact of an officially declared calamity, so if there are multiple restructuring or multiple resolutions that are happening, so for the multiple resolutions or for multiple restructuring, there is additional provision of 5% for each restructuring stance. So for each restructuring stance, there is additional provision of 5% that has to be maintained, but the total provisions, that is the normal provisions plus the additional provisions, cannot exceed 100% of the loan value. Okay? Now, the additional specific provision may be written back upon the borrower paying at least 20% of the outstanding debt. So if the outstanding debt is of 10 lakhs, if 20%, that means 2 lakh has been returned to the bank. So if the borrower has paid at least 20% of the outstanding debt with the bank, so without slipping into NPA, so the provisions can be written back. That means the bank that is maintaining the additional provisions, it can stop maintaining the additional provisions. That is it. So if the borrower is paying at least 20% of the outstanding debt without becoming NPA even after the calamity, so in this case the additional provisions can be written back. Okay. If the borrower's outstanding post restructuring exposure, after the restructuring, the exposure is only in the form of non-fund based facilities like the guarantees and such, or cash credit or overdraft limits. So a proper loan has not been taken, only overdraft or cash credit facility was taken, non-fund based facilities were taken, the bank may reverse the additional specific provisions after 1 year of implementing the restructuring or the resolution plan. So after 1 year, so in these cases where the proper loan has not been taken, so within 1 year, after the 1 year, the provisions can be written back, the additional provisions can be written back. Okay. Now, try to give the right answer of this question. Chalo. Under the Reserve Bank of India disbursement of government pension by agency banks directions 2026, which of the following categories of banks are recognized as agency banks for pension disbursement? So this we have discussed already in the Finance 360-degree session. So I hope you will be able to answer this question, that which of the following banks can become the agency banks? Try to answer this. So see, the government regarding the agency banks, there were two directions that were released. One direction was for the government pension specifically, and the other direction was regarding the conduct of the agency bank. So I've taken a detailed session under the Finance 360-degree for the conduct of the agency bank, because there were multiple facts that were under the conduct of the agency bank. For the government pension, there are not many facts. That's why we will discuss it here only. Okay. So under the RBI disbursement of government pension by agency banks directions 2026, which of the following categories of banks are recognized as agency banks for pension disbursement purposes? So public sector banks, private sector bank, payment bank, small finance bank, these are the category of banks that can be recognized as the agency banks. So 1, 2, 3 and 4, this is the right answer. C is the right answer. Okay. So this is the idea that agency banks which are authorized to disburse central bank and state bank pension, they are the public sector bank, scheduled private sector bank, scheduled payment bank, and the scheduled small finance bank. Now, as per the disbursement of government pension by agency banks directions, earlier government orders relating to dearness relief were passed to the agency banks through the RBI. Now the government has said that we will directly give it to the banks. The RBI intervention is not required. So agency bank shall take suo motu action, that is direct action based on the government notification, and implement them immediately without waiting for further instructions from the RBI. If there is any excess pension that is mistakenly given by the banks to the pensioner, so the banks have to refund to the government. If any excess or overpayment has been made to the pensioner due to an error from the agency bank, then the bank must immediately credit the entire excess amount to the uh, government account in one lump sum, irrespective of they are able to retrieve it from the pensioner or not. Withdrawal of pension by old, sick, disabled person. So basically, it has been said that if a pensioner is unable to sign but can provide a thumb or toe impression, the impression must be verified by two independent witnesses known to the bank, including one responsible bank official. If the pensioner is unable to physically visit the bank and cannot provide the thumb or toe impression, a simple mark may be taken on the check or withdrawal form, and this should be verified by two independent witnesses, including one responsible bank official for taking out the pension. Okay. The responsible bank official verifying the thumb impression or the mark must belong to the same bank, preferably to the same bank branch also. Okay. So for the pensioners who are too ill to sign a check, they can provide their thumb impression. If the pensioners, they are incapable of putting their thumb impression or the toe impression, they can put a mark. Okay, that is the idea, and that should be verified by two independent witnesses. That is all the facts that are present here. Basically, if an agency bank has already disbursed the pension to pensioners on behalf of the government, its the link branch of the agency bank may submit reimbursement claims to the RBI Central Account Section, Nagpur, for the central government pensions, and to the government banking division at the respective regional office for the state government pension. Okay. Now, Coming to the next question, try to answer this question with reference to the RBI disbursement of government pension by agency banks directions 2026. The recommendations of the Prabhakar Rao committee primarily relate to which of the following? So as I've told you that under the agency banks government pension directions, there are not many facts. Just you have to remember that in case of sign is thumb impression is being taken or mark is being taken. In this case, in this particular case, the two independent witnesses should be there, including one bank official. So this is the idea. Next is Prabhakar Rao committee primarily relate to which of the following? Think about it. Revision of DNS relief calculation methodology for pensioners? No. It is for the customer service standards and pension payments of banks. Okay. So E is the right answer. So agency banks must ensure that their branches comply with the recommendations of the Prabhakar Rao committee on the customer service relating to pension payments. So this is something that you have to remember, that this committee, Prabhakar Rao committee, is related to the customer service relating to pension payments. The rest not very important. Agency banks must appoint one or two nodal officers at each region or zone to regularly monitor and restore to resolve the pensioners' grievances. So for the pensioners' grievances, there is the appointment of one or two nodal officers at each region or zone that is required. Okay. Now coming to the next question, try to answer this. Now before that, uh, agency bank should compensate the pensioner for delay in crediting pension or arrears. Let's say the pension has been delayed by 15 days. The pension has been delayed by 15 days. So the for the delay, the compensation has to be paid by the bank because the bank has done the delay. So agency bank should compensate the pensioner for delay in crediting the pension to the account of the pensioner. And what is the compensation? Fixed interest rate of 8% per annum for the period of delay for the amount that is delayed. That is the idea. Now, try to answer this question. So for the agency banks, there are two directions that are released. One is the disbursement of government pension by agency banks that we have recently discussed in the above articles. And one is the conduct of government business by agency banks, payment of agency commission and oversight of agency banks. So this direction, I have taken a detailed session under the Finance 360-degree session for this particular article, that is conduct of government business by agency banks, payment of agency commission and oversight of agency banks. Okay. So for this, I've taken a detailed session, and this we have recently discussed above. So try to answer this question. Okay, E is the answer. Which of the given statement above, which of the statements given above are correct? Pensioners are entitled to compensation at the rate of 8% per annum for delay in credit of pension or arrears caused due to the error of the agency bank. This we have just discussed. So absolutely correct. The maximum number of pension transactions eligible for agency commission is restricted to 14 per pensioner in a financial year. Absolutely correct. Okay. 12 monthly payments and plus 2 additional payments. So in total, 14 payments are allowed. 14 pension payments are allowed for the agency commission for per pensioner by the agency bank. Okay, where the pension related work is shared between two banks, the agency commission is divided between them in the ratio of 75 to 25. This we have discussed. So 1 and 2 is the right answer, and that's why the correct answer here is A. Very good, everyone. Very good. Agency bank should compensate the pensioner for delay in crediting the pension or arrears if it is the mistake of the agency bank with the fixed interest rate of 8% per annum. This is the compensation that has to be paid. If agency banks handle the entire pension disbursement process by themselves, so they will get the agency commission. So if the agency bank is handling the calculation of the pension and the entire pension disbursement process, so in this case, agency commission will be given to the agency bank for the pension disbursement, for the pension payment transactions. But let's say the pension calculation is being done by the government department or the treasury, and only the transaction is done by the agency bank. In this case, the transaction will be considered under the other than pension payment transactions, because the half of the task was done by the treasury and only half of the task is done by the agency bank. So rather than getting the compensation, or rather than getting the agency commission under the pension payment transaction, the agency bank will get the commission under the other than pension payment transaction. Now, the number of pension transactions that are allowed for per pensioner in 1 year for the agency commission cannot exceed 14 transactions, and the commission sharing happens between the two agency banks within 75-25 ratio. 75% for the agency bank that has done the transaction, and 25% for the agency bank that is recording the transaction or accounting the transaction and dispatching the information about the transactions. Now, try to answer this question. Under the Reserve Bank of India, conduct of government business of by agency banks, payment of agency commission. Try to answer this question. Agency commission for pension payment transactions has been fixed at 80 rupees per transaction. Receipts processed through electronic mode are eligible for agency commission of 12 rupee per transaction. Agency banks are required to submit their commission claims within 60 days from the close of the relevant quarter. Incorrect agency commission claims attract penal interest at rate of repo rate plus 2%. So which of the above is the correct or are incorrect statements? Which of the statements given above is or are incorrect that you have to tell? C is the answer. Okay, 2, 3 and 4 are incorrect. 2, 3 and 4 are incorrect. Only fourth statement is incorrect. First is correct. Agency commission for pension payment. Say agency commission for pension payment is 80 rupees. And if the agency commission is doing the pension calculation, is doing the transaction of the pension, then 80 rupees is the agency commission for the agency bank. But let's say the treasury or the government department is doing the pension calculation and the agency bank is only doing the transaction of the pension, then the agency bank will get the commission, agency commission of 7 paise per 100 rupees. This is the payment other than pension. For the receipts e mode per transaction 12 rupee, for the receipts physical mode 40 rupees. So 1, 2 and 3 statements are correct. That means agency commission for pension payment transaction is 80 rupees. Receipts processed through electronic mode are eligible for agency commission of 12 rupees per transaction. Agency banks are required to submit their commission claims within 60 days from the close of the relevant quarter. This is also correct. So first, second and third statements are correct. Only fourth is incorrect. Why is it incorrect? Because whenever, see, if the agency commission is incorrectly shown to the RBI, because RBI is the one, see, RBI is the one that is hiring the agency banks. RBI is the banker to the government, to the state government and to the central government. Now, RBI has the responsibility to do the banking business on behalf of the central government and the state government. But RBI cannot do all the transactions itself. RBI cannot collect all the receipts and cannot make all the payments itself on behalf of the central government. So, RBI hires the agency banks, and agency banks, for the receipts that they are collecting on behalf of the central government, for the payments that they are making on behalf of the central government, for collecting the taxes, for collecting the small saving schemes amounts, for collecting the fees, fines, for paying the pension, for paying the salaries, for paying the different amounts, the agency banks get agency commission. For the pension payment transaction, 80 rupees. For the receipts processed through electronic mode, 12 rupees. For the receipts collected through physical mode, if the taxes are paid on the physical mode basis, so 40 rupees is the agency commission per transaction. Now, if the incorrect agency commission has been claimed, so in this case, RBI will penalize the bank at the rate of bank rate plus 2%. Okay? Bank rate plus 2%. If the pensioners are if the delay has happened, if the delay has happened in paying the pension, then the compensation is 8% per annum. Okay? But let's say the agency commission has been wrongfully claimed, or wrong amount has been claimed for the agency commission under the RBI. So the penal interest rate is the bank rate plus 2%. And whenever the banks are penalized, usually they are penalized at the bank rate, Okay. So compensation is different and the penalization is different. Here the banks are being penalized at the bank rate plus 2%. This is the idea. Okay. So agency banks shall furnish their claims for agency commission to RBI within 60 calendar days from the end of the quarter in which the transactions were conducted. And if the agency banks, if they are wrongfully claiming or they are settling wrong agency commission claims, or wrong agency commission claims are being announced, okay, if there are the wrong agency commission that is being demanded, so agency banks will be liable to pay the penal interest at bank rate plus 2%. This is the idea. Now coming to the next question. The biometric enabled digital life certificate system known as Jeevan Praman, referred to in the RBI disbursement of government pension by agency banks directions 2026, was introduced by which of the following authority? So as I've told you that the disbursement of the government pension by agency banks, I've not taken a separate session on this particular article, but here we have discussed the important points, and through 3 questions, I've shown you the important things that you have to remember here. Okay. So this particular article, under this, the Jeevan Praman was introduced by, it was introduced by Central Pension Accounting System or Central Pension Accounting Office. So Jeevan Praman is a biometric enabled digital life certificate system based on Aadhaar authentication introduced by the Central Pension Accounting Office of Ministry of Finance. Agency bank shall implement the scheme and create awareness among the pensioners. Okay. So see, remember this, that we have discussed about the pension disbursement. Okay. So here, disbursement of government pension by agency banks. First, we discussed that the government orders will be taken directly by the banks for the DNS relief, as well as if the thumbprint cannot be taken, then any other mark will be taken by from the pensioner with 2 witnesses. And if the signature cannot be taken, then the thumbprint will be taken with 2 witnesses should be present. Then we also discussed about the customer service, like under the Prabhakar Rao committee, there is the customer service related to pension payments norms that have been laid down. So Prabhakar Rao committee has recommended the rules and regulations and the norms regarding the customer service relating to pension payment. Then we discussed about the like the compensation that the banks have to pay to the pensioners if there is delay in payment. And then at last we discussed about the Jeevan Praman. So these are the important points from the disbursement of government pension by agency banks. Okay. So this article is also done. Now coming to the next one. What is the name of the mission mode capacity building initiative launched by the Reserve Bank of India for strengthening personal training in the urban cooperative banking sector? So it has been said that the RBI has launched a mission to train the employees or to train the personnel of the urban cooperative banks. Which is the mission here? Which mission is being discussed here? So it is mission Saksham. Very good. Mission Saksham. What is the full form of Saksham? So it is Sehakari Bank Shamta Nirman. Okay. So mission Saksham is the Sehakari Bank Shamta Nirman. Okay. So that is the idea. Now, under this mission, the training programs are being run by the RBI. This would be conducted for the urban cooperative banks. The target groups for the training are the board members, senior management, heads of the risk compliance and audit functions, and employees working in IT functions and other critical areas. Basically, Mission Saksham aims to establish a sustainable self-reinforcing ecosystem for continuous learning, contributing significantly to the systemic stability and healthy growth and development of the urban cooperative bank sector. That is the idea. Okay. Now, RBI recently signed a MOU on cooperation in the field of central banking with which of the following institutions? So, RBI has recently signed a memorandum of understanding on cooperation in the field of central banking with which of the following institutions? Is it the Bank of England, International Monetary Fund, European Central Bank, Bank for International Settlements, or Asian Development Bank? With which of the following bank the MOU has been signed on the cooperation in the field of the central banking? So, it is European Central Bank. Okay. So such kind of direct questions can come in the phase 1. So this is important from the phase 1 perspective. The idea is that the RBI and the European Central Bank, they have signed the MOU on the cooperation in the field of central banking. They will regularly exchange the information, policy dialogue and technical cooperation will be done by the 2 institutions. Coming to the next one, with reference to the determination of significant increase in credit risk under the Reserve Bank of India Commercial Bank's Asset Classification, Provisioning and Income Recognition Directions 2026, match the list 1 with list 2. So remember this, that this is a very big direction that we have discussed. We discussed about the asset classification norms that have not been changed, but we discussed about the norms that were laid down. We discussed about the provisioning that will be under the expected credit loss provisioning framework, and we have discussed about the income recognition, for which effective interest rate has been introduced, and effective interest rate for all the new loans will be applicable from 1st April 2027. For the old loans that are still outstanding, by 31st March 2030, it will be applicable. Okay. So the effective interest rate for the old loans that are still outstanding till they have 31st March 2030 to adopt the effective interest rate. So from 1st April 2030, they need to have the effective interest rate. This is for the old loans that are still outstanding. For the new loans from 1st April 2027, the effective interest rate should be adopted. Now, stage 1, stage 2 and stage 3, we have discussed them in detail. So try to answer this. Stage 1, the loans basically under the stage 1, there are the standard assets, right? There are the standard assets that do not have the significant increase in credit risk. They do not have any increase in the credit risk. So they are expected to maintain the provisions for the expected credit loss that can happen in the next 12 months. The credit loss that can, or the default that can happen in the next 12 months. So A ka 1. Now stage 2. Stage 2, here also the loans are standard assets, but they are under stress. So there is significant increase in credit risk. There is significant increase in credit risk for the past 30 days or for past 60 days. The payments have not been made. That means there is some problematic situation. So stage 2, the significant increase in credit risk but not yet credit impaired. The loan has not become NPA but stress has increased. So B ka 3. And here the expected credit loss can happen in any lifetime in the next 12 months, or in the lifetime of the loan the expected credit loss can happen. Now for the stage 3, the financial, in this case the asset has become non-performing asset, there is significant increase in credit risk, the loan has become NPA. So financial instrument is credit impaired at the reporting date, the loan has become NPA. Sorry, A ka 2, B ka 3 and C ka 1. So right answer here is A. Okay. So stage 1 applies where the financial instrument has not experienced a significant increase in credit risk since initial recognition. Banks recognize the expected credit loss for the next 12 months, that in the next 12 months the default can happen. Stage 2 applies where there has been significant increase in credit risk but the loan has not become NPA. So in this case, the lifetime expected credit loss, that means the expected credit loss, the default can happen in the lifetime of the loan. Stage 3 applies to such financial instrument that have become NPA, that have become the credit impaired. In this case also it is considered that the expected credit loss can happen at any time in the lifetime of the loan and the provisions have to be maintained according to that. Okay. Now the bank not required to determine the SICR. That means these loans will, these will always come under the stage 1. So the SLR eligible instruments, statutory liquidity ratio eligible instrument, that are the central government securities, and the SLR eligible state government securities, they will always come in stage 1. Central government securities and the SLR eligible state government securities will always come in stage 1. Direct claims on the central government guaranteed by the central government, basically exposures fully guaranteed by the central government. So direct claims, direct loans to the central government or loans against the full guarantee of the central government, they also come under the stage 1 only. Exposures to foreign sovereigns, foreign central banks, multilateral development banks will attract a risk weight of 0%. Bank for international settlements and such, they will also attract a risk weight of 0%. So they will also come under the stage 1. Now coming to the next one, the measurement of expected credit loss framework under the RBI asset classification, provisioning, income recognition norms. What is the formula, or what are the parameters on which the expected credit loss depends on? So expected credit loss is measured through what formula and through what parameters? Try to answer this. So for the expected credit loss, what are the parameters for calculating the expected credit loss? Any idea? What are the parameters for calculating the expected credit loss? Yes, it is probability of default, loss given default, and exposure at default, So probability of default should not be less than. What is the minimum requirement, or what is the minimum threshold? What is the minimum regulatory floor for the probability of default? Anyone remembers? Is it 0.01%? Is it 0.03%? Is it 0.05%? Is it 0.10% or 0.15%? What is the probability of default minimum regulatory floor by the RBI? It is 0.03%. Okay, so probability of default cannot be less than 0.03%. Let's say the bank has decided that the probability of default is 10%. Okay, this is the probability of default happening. Loss given default, if the default happens, the loss can be 40%, and exposure at default is 10 lakh. So according to that, the ECL will be decided, the expected credit loss will be decided, and this much provisions will be maintained. Now if the provisions, let's say the provisions are 1 lakh or 10,000. Now, if it is less, now the RBI has also provided the minimum provision requirement of 5% for the stage 2 and 25%, starting with 25%, let's say for stage 3 and such. So the minimum provisions, this has to be seen, that the first ECL provisions, if they are higher than the minimum provisions of the RBI, then the ECL provisions will be maintained. But if the ECL provisions are less than the minimum required provisions by the RBI, so the minimum required provisions by the RBI has to be maintained. That is the idea. Now, how the ECL provision, or how the ECL is calculated? Through the probability of default, loss given default, and exposure at default. So 1, 2, and 5, D is the answer. Yes. Now, coming to the next question. So this we have discussed, probability of default cannot be lower than 0.03%. Loss given default is decided by the bank, that according to the historical data and experience, the loss given default can be 10%, 20%, 30%, 40, 50, 60 loss if default happens. Now, in case the bank is not able to estimate that what is the loss given default, so RBI has said that for the secured portion, the loss given default should be taken at 65%. Unsecured portion, the loss given default should be taken at 70%. If the bank is not able to calculate it itself, then these RBI's backstop values can be used. If the loan is backed by very safe assets like gold or cash equivalent such as the fixed deposit and such, or government securities, LIC policy, Kisan Vikas Patra, National Savings Certificate, loss given default will be 30%. So these are the important data that you have to remember. Now coming to the next question. As per the expected credit loss framework prescribed under the RBI directions, mandatory collateral valuation at the time of stage 3 classification and thereafter at least once every 2 years is required for stage 3 exposures exceeding what? So it is said that as soon as the loan is becoming NPA, that means the loan is coming under the stage 3 category. If the loan is more than 7.5 crore, then the collateral valuation should happen immediately when the loan is becoming NPA, when it is entering the stage 3, as well as once in every 2 years the collateral valuation should be repeated. So here the answer is 7.5%, 5 crore, sorry. So basically, when banks calculate expected credit loss, they do not assume that the entire loan amount will automatically be lost. The banks know that they have the collateral. If the stage 3, that means the loan has become NPA of more than 7.5 crore, in this case collateral should be valued immediately when the loan is becoming NPA, and at the time of the stage 3 classification and thereafter at least once every 2 years. If the loan is becoming NPA and coming under the stage 3, and there is the stock or inventory that the bank has the collateral as, so bank must revalue the stock or inventory collateral at least once every year. Okay, this is the idea. Now if a company has directors that are listed as willful defaulters and the bank has provided the loan to such company, so in this case additional 5% provisions have to be maintained. The EIR, that is expected, sorry, first old provisioning system. Now the RBI has said that from April 1st 2027, from April 1st 2027, the banks have to move to the expected credit loss provisioning norms. So from the old provision norms to new provisioning norms, the movement is required if there are more provisions. Now the old loans or the outstanding loans will be calculated, and the fair value will be seen, and higher provisions should be maintained if required. So these higher provisions should come from retained earnings, okay. Now the retained earnings cannot be reduced. Retained earnings that come under this common equity tier 1 capital. So common equity tier 1 retained earnings and the common equity tier 1 capital should not be reduced in one go to increase the provisions according to the new norms. So in this case, there is the pathway that is given, that in the first in the 2027-28, in this first financial year, 1/5 of the common equity year 1, like the provision requirement can go from the common equity tier 1. Fourth fifth should be kept in the common equity tier 1 only, okay. So maximum fraction of the transitional adjustment amount that may be added back to the common equity tier 1 capital is 4/5. Now in the second year, the deduction should be 2/5, and should be kept 3/5 should be kept in the common equity tier 1, and so on. So basically, if the provisions have to be increased according to the expected credit loss framework that is going to be applicable from 1st April 2027. So if higher provisions have to be maintained in comparison to the older norms, in this case, the higher provision should come from the common equity tier 1 capital, but not in one go, slowly and slowly. The common equity tier 1 from the retained earnings, the provision should be increased. Okay. Now, income recognition, I have told you that the effective interest rate method has to be followed from 1st April 2027 for all the new loans, but for the older loans that are outstanding, for them by 31st March 2030, the effective interest rate has to be followed. That is so that from 1st April 2030, all the loans must mandatorily use the effective interest rate. So for the new loans, effective interest rate should be followed from 1st April 2027. But for the older loans that are still outstanding, by 31st March 2030, the effective interest rate has to be followed. Okay. Now, coming to the next question, this is the question. Like I have not discussed this article in the Finance 360-degree session. Like this article has been discussed. The asset classification, income recognition, provisioning. This has been discussed in detail in the Finance 360-degree session. But this article has not been discussed in the credit cards and debit cards issuance and conduct directions have not been discussed in the Finance 360-degree session, because there is only one or two data points that you have to remember from here. So that we will discuss in this session itself. So the Reserve Bank of India, through amendments to the Commercial Banks Credit Cards, Debit Cards, Issuance and Conduct Directions 2026, has prescribed that a credit card account shall be treated as past due for reporting to credit information companies only when the payment remains overdue beyond how many days, basically. So let's say your due date was 24th of May. You forgot to pay. Now, should directly the credit information companies be informed that the person has not paid the due amount in the credit card for the credit card? So basically, it has been said by RBI that at least 3 days time period should be provided. At least 3 days time period should be provided from the due date. So right answer is C here. Okay. Mayank, you will get this PDF in the Telegram channel of EduTap. Okay, Telegram channel of EduTap. And all the directions for May, your May session is going to happen next week. So all these will be discussed in detail in the next week section. So you do not have to worry about that. Okay. Like in the coming week from Monday na. So in this coming week, I have the budget economic survey session with you in course. I have the May session also with you in course. So in that session, we will discuss this in detail. But right now, you can just have the summary view here. So see, RBI has now brought an amendment to the Commercial Bank's Credit Card, Debit Card Issuance and Conduct 2025 directions to align it with the updated asset classification provisioning directions. Now, the enforcement of this direction regarding the credit card and such is also from 1st April 2027. Basically, the idea is that a credit card account will be reported as past due to the credit information companies, or penalty will be levied. If any, the penalty will be levied if the amount remains unpaid for more than 3 days after the due date. So from the due date, further 3 days time period is given so that the person can pay without major penalty and such. So card issuer shall report a credit card account as past due to the credit information companies or levy the penal charges, late payment charges or such only after 3 more days of the past due. the number of days past due and late payment charges. See, if the 3 days has also passed and then also you have not paid from the past due, the 3 days have also passed, then also you have not paid, then the penal charges will be applied from the date of the due date. Okay, so the 3 day of the grace period is provided to you so that you can pay if you have forgotten, so you can pay in the 3 day time period, and your account will not be considered as past due and will not be informed to the credit information companies. But the 3 day has also been passed and still you have not paid, then the credit information companies will be informed, and from the date of your past due, from then onwards the penal charges can be applied. That is the idea. Now coming to the next question, which organization's 7 category classification may be used by banks for classification and provisioning of country risk exposures until banks shift to the internal country risk rating system? So basically, it has been said that let's say the bank has the exposure. That means the bank has provided the loans or bank has provided the investments, has done the investment um, in a country, let's say Luxembourg. Now, so bank has exposure. Bank has provided loans to the entities of Luxembourg. The bank has provided the investment, has done the investment in the entities in Luxembourg and such. So bank has basically, the bank has the exposure to a particular country, okay, or let's say Ireland. So bank has exposure to a particular country. Now, how much provisions shall be maintained by the bank against this exposure? Shall we only depend on the international ratings? But what if the international ratings that are provided in this country are incorrect? So the banks will not be able to guess the exposure correctly. That's why the RBI has said that there should be internal country risk rating system also. So the bank should internally should also provide ratings to the different countries and the exposure to the different countries. So on the basis of the rating, the investment in the Ireland companies is the rating of AA or BB. So according to the rating, the bank will also maintain the provisions and the capital and such. So this is the idea that basically the bank should not only depend on the international ratings, the bank should not only depend on the external ratings that are provided to the different countries and the entities of different countries. There should be some internal country risk rating system so that the banks, they are not completely exposed to the external entities and the ratings provided by the external entities. So right now the banks, they, if they do not have the internal country risk rating system, so banks can use the 7 category classification provided by which entity? It is ECGC. Very good, very very good. ECGC is the one. So again, this is all that you have to remember from here. I will take a detailed session on this in the next Finance 360-degree session on Tuesday or Thursday. I will take a session on this because there are some nitty-gritties that you have to remember from the unhedged foreign currency exposure, so that we will discuss in the session, in the detailed session. So I've not brought everything here because that would make the session very lengthy. So I will take a detailed session on this particular article. For now, you have to remember that a bank shall put in place appropriate system to move over to internal assessment of the country risk, and shall evolve sound systems for measuring and monitoring the country risk. Because if a bank is having the exposure to the entities of other country and the bank is only depending on the external rating or the international rating of the entities of the other country, then the bank is completely exposed that what if these ratings are incorrect? Because I hope you know about the 2007-2008 US financial crisis, the subprime crisis. In this case, also what happened that the very good credit ratings were provided, or very good ratings were provided to the securitized receipts, due to which the whole, like the housing loan securitized receipts, they got very high rating. And many of the investment agencies, many of the investment banks, many of the banks of all over the world, many of the investment investors all over the world, they invested in the securitized instruments because of the high credit rating and because of the housing bubble in US. And as soon as the bubble burst, you know what happened, the whole crisis happened, the US crisis happened, that affected many of the countries. So RBI is saying that banks should not only depend on the international ratings or the external ratings, because that is according to their norms, that is according to their idea. Banks should have the internal assessment of country risk until bank develop their own internal system for assessing assessing and monitoring the country risk, they may use the 7 category country risk classification system followed by the ECGC. Okay, so that is the idea. And we will have the detailed discussion on this particular article, where we discuss about the provisioning capital requirements for the unhedged foreign currency exposure and such in the detailed session in the Finance 360. Now coming to the next article. From here onwards, the April articles have started. We have discussed the May ones. Chalo. Try to answer this. Now, I think all of you should be able to answer these questions because I have already taken the monthly revision session. I've already done the Finance 360-degree sessions with you. So I'm not going to discuss in detail now because already the new articles we have discussed and I have shown you the question and the detailed explanation. But for the April articles, because I've taken the monthly revision session, for the March articles also I've taken the monthly revision session. I've taken all these topics in the Finance 360 or monthly revision session. So now let's be a little more faster and try to answer this question. Under the Reserve Bank of India trade relief measures directions, given the continuing logistical disruptions due to the West Asia crisis, it has been decided to extend the enhanced export credit period of how many days for all the disbursals of the loan done by the commercial banks, primary urban cooperative bank, state cooperative bank, central cooperative bank, NBFC factors, and all India financial institutions till June 30, 2026. So basically, it has been said that for the export credit, the repayment for the repayment of the export credit, for the repayment of the export loans, there is the extended time of how many days that is provided. 450 days. 450 days. Okay, so basically the loans previously they had to be returned within 1 year, or the export credit it had to be repaid within 270 days or 1 year. Okay, for the uh, pre-shipment 270 days, for general loans 1 year. Within 1 year the loans had to be repaid, or within 270 days the loan had to be repaid. But now it has been said that 450 days will be provided. 450 days will be provided for the repayment of the export credit till this time period, like if the loan has been taken till June 30, 2026. As well as there is another trade relief that is provided. So under the trade relief measures for the exporters, it has been said that the pre-shipment and post-shipment export credit, that is export loan, have to be repaid now within 450 days, not 270 or not 1 year. Within 270 days the loans have to be repaid. Okay, and it has been said that the export, let's say the exporter is doing the export, the exporter had to bring back the payments within 9 months. Okay, so if the export is being done, then within 9 months the exporter had to bring back the payments. But now this time period has been extended from 9 months to how many months? From 9 months to how many months? 15 months. 15 months. Okay, so from 9 months to 15 months. So this is the idea that for the export credit, for the export credit, that is for the export loans, they can be repaid within 450 days now, rather than following the 1 year or 270 date criteria. As well as the export, like for the export, the payments before had to be brought back to the country within 9 months. Now 15 months is the time period that is given. These were the facilities that were provided, or these were the trade relief measures that were provided in 2025, and they have been extended in 2026. This is the idea. Now coming to the next question. With effect from 1st April 2026, the processing of overseas investment references or the applications submitted by the authorized dealer banks through the Prava portal has been decentralized to what? So basically what happens that, let's say the Indian residents, the Indian individual residents, or the Indian entities, resident entities, the resident entities or the individual residents, if they want to do the investment with the approval of the RBI, and they need to take the approval of the RBI because the investment is happening through the approval route. So the Indian residents, the individual residents or the resident entities, they can take the approval from the RBI through the authorized dealer, which sends the application to the central office, which used to send the application to the foreign exchange department of the central office of Reserve Bank of India. Now it has been said that the authorized dealers, rather than sending the application to the central office foreign exchange department of RBI, they can send the application to the regional office, to 7 regional offices of RBI. Okay, so this is the idea that if the individual residents or resident entities, if they want to do the investment under the approval route, then before the approval had to be taken through the authorized dealer from the foreign exchange department of the central office of RBI. Now before there was the centralized mechanism, foreign exchange department had to handle all the applications. Now the 7 regional offices, they will be able to process the applications, they will be able to do this process. Okay, so C is the answer. So earlier, if an Indian person, that is resident individual or the resident entity, wanted to invest money abroad under the approval route, requests related to such overseas investment were received through the authorized dealer bank and were processed centrally at the foreign exchange department of the central office of RBI. Now the RBI has shifted to the decentralized system from 1st April 2026, and overseas investment references request application shall be processed at 7 regional offices. In any case under the approval route, the designated authorized dealer bank shall forward the proposal to the concerned regional office of the RBI through the Prava portal. Okay? So designated regional offices will receive the applications, will receive the request through Prava portal of the Reserve Bank. This is the idea. Now coming to the next one, with reference to FPI investment limits for financial year 2026-27, the total notional value of credit default swap sold by all FPIs together shall not exceed what percentage of the total outstanding stock of corporate bonds in India. I hope you remember that there are the limits that are decided for the FPIs every year by the RBI, that how much they can invest in the central government securities, how much they can invest in the state government securities, how much they can invest in the corporate bonds, as well as there is also the limit for the FPIs for the credit default swap. Again, I have taken a detailed session on this. I have taken the topic in the monthly revision session also. So what is the limit for the foreign portfolio investors for the central government securities? How much can be invested by the foreign portfolio investors in the central government securities? Anyone? 6%. For the state government securities, 2%. For the for the corporate bonds, 15%. And the foreign portfolio investors can provide the credit default swap that should not exceed 5%. That should not exceed 5% of the total outstanding stock of corporate bonds in India. Okay, so these are the percentages that you have to remember. So every year the RBI undertakes an annual exercise where the RBI reviews and prescribe the limit for foreign portfolio investors: 6% for the central government securities, 2% for the state government securities, and corporate bonds, 15% for the corporate bonds. As well as it has been said that the credit default swap can be provided by the foreign portfolio investors, but it should not exceed 5% of the total outstanding stock of corporate bonds. Credit default swap is basically if the entities, they are investing in the corporate bonds, then they are afraid that what if the corporate entity do not repay the money. So the entities, they can purchase the credit default swap, that if the default happens by the corporate, then the other entity will be responsible to handle the default. Okay, so that is credit default swap. And the other entity, it gets the regular premiums for taking the risk. Now, coming to the next question, that is regarding the master direction on incentives for currency distribution and exchange and penalties. Consider the following statements regarding penalties for deficiency in customer service. So, with reference to the master action on incentives for currency distribution and exchange and the penalties, consider the following statement. A penalty of 10,000 per instance may be imposed on banks for refusal to exchange damaged notes. So, basically, if there is deficiency in service, so there is the penalty of 10,000 per instance and the penalty of 5 lakh if there are more than 5 instances. Absolutely correct. Small finance banks up to 2 years from the commencement of their banking business and urban cooperative banks, they may exchange mutilated and imperfect notes at their option. So this is incorrect. This is incorrect because it is not urban cooperative banks. It is payment bank. Okay, small finance bank up to 2 years from the commencement of their business and the payment bank, they may exchange mutilated and imperfect notes at their option. A penalty of 10,000 levied irrespective of the amount involved in the on the currency chest if the soiled note remittances to RBI are reported as withdrawal by CC, withdrawal by currency chest. Think about it. 10,000. Did we not discuss this, that if there is the soil note remittance, if there is the soil note remittance, if they are reported as withdrawal, if wrong reporting is happening, in this case 50,000 is the flat penalty. If the diversion, if the money is going from one currency chest to another currency chest, then this will come under the diversion module. It should not be reported as withdrawal or deposit. If the diversion is being reporting it as withdrawal or deposit, there will be a flat penalty of 50,000. If the net deposits have happened in the currency chest and they are not reported correctly, then also the flat penalty should be 50,000, right? So this is incorrect. The flat penalty is of 50,000. Okay. So first is correct, second and third are incorrect, and that's why the right answer here is D, incorrect statement. So this is the idea. Deficiency in service for the bank branches, 10,000 per instance of the deficiency. So this is the penalty. 5 lakh in case of more than 5 instances. For counterfeit notes detected in ATM, 10,000 is the penalty. Small finance bank and payment bank, they may exchange mutilated and imperfect note at their option. For these kind of irregularities, the flat penalty is 50,000. Okay. Non-compliance with operational guidelines, the currency chest. If they are not complying with the operational guidelines, then penalty is 5,000, which is enhanced to 10,000 in case of repetition or recurrence. Violation, if any violation is being done by the currency chest in the rules and regulations, then 10,000 for the violation and 5 lakh in case of more than 5 instances. Banks are paid an incentive of 65 rupee per bag of coins for distributed, and an additional of how much per bag is provided for distribution in rural and semi-urban areas to promote better coin circulation. Banks are paid an incentive of 65 rupee per bag of coins distributed, and an additional of 10 rupees per bag. This is provided for distribution in rural and semi-urban areas to promote better coin circulation. So 10 is the answer here. And these are the incentives. If the bank is opening the currency chest in difficult areas, northeast or hilly inaccessible areas of Jammu and Kashmir and Ladakh, so bank can get up to 100% reimbursement of the capital cost, subject to the maximum of 50 lakh. And in case of the revenue cost, 50% will be covered for the first 5 years. Exchange of notes, soil notes, 2 rupees per packet is the incentive. Mutilated notes, 2 per piece is the incentive. Distribution of coins, 65 rupees per bag, and additional of 10 rupees per bag for the distribution in rural and semi-urban areas and such. Okay. Now coming to the next question, with the reference to the master direction on incentives for currency distribution and exchange and penalties, what is the penalty? What is the penalty that is imposed on the currency chest for counterfeit notes that are detected in soil note remittances of 100 rupee and above, with counterfeit notes per million notes of 5 or higher but less than 20? So think about it. Counterfeit notes per million are 5 or higher but less than 20. In this case, if the currency chest in the currency chest like if the currency chest has given the soil note remittances, that means currency chest has sent the soil notes to RBI, in which in the soil notes there are counterfeit notes that have been detected of 100 rupees and above, with counterfeit notes per million being equal to or more than 5 but less than 20. So penalty should be 150%. Very good. If the CPM, if the counterfeit notes per million is less than 5, then the penalty should be 100%. And if the counterfeit notes per million is more than 20, more than or equal to 20, then the penalty will be 200%. So very good. Here the right answer is C, that is 150%, because the counterfeit note per million is 5 or more than 5 but less than 20. So C is the answer. Okay. So this is the idea that counterfeit notes detected in the soil notes remittances, so 100 and above, recovery of notional value plus penalty. Penalty will be 100%, 150%, 200% on the basis of the counterfeit note per million. But if the counterfeit notes are found in the balance of the currency chest, if the counterfeit notes are found in the balance of the currency chest, then in this case, if the notes are 100 rupee and above, then what will be the penalty? The penalty will be 200% directly. The penalty will be 200% directly with the notional value that is recovered. Now coming to the next question, that is regarding the floating rate savings bond. Try to answer this. Consider the following statements regarding the RBI's operational guidelines on the floating rate saving bond 2020 taxable guidelines that have been updated. The floating rate saving bond have a lock-in period of 7 years. Payment for subscription can be made in cash up to 25,000. The minimum investment in the bonds is 1000 rupees. Which of the above is correct? Which of the above is or are correct? C is the answer, 1 and 3. Absolutely correct. Very good. So floating rate saving bond have a lock-in period of 7 years. The payment for subscription can be made in cash up to 20,000. The minimum investment in the bond is 1000. So first and third are correct. Second was wrong. And that's why the right answer is C here. Okay. So basically eligible investors for the floating rate saving bond, the eligible investors are resident individuals and Hindu undivided family. The investment structure, the minimum investment should be of 1000 rupees and investment multiples in 1000. Maximum investment, there is no maximum limit. Issue price, lock-in period is 7 years. Payment in cash can be only up to 20,000. Okay. Eligible nominee can be resident Indian or NRI but not the overseas citizen of India. Coming to the next one, as per the reference to the recently updated RBI's operational guidelines of floating rate saving bond, the coupon of the floating rate saving bond, that is the interest in the floating rate saving bond, is linked to the national saving certificate rate with an added spread of very good 35 basis point. Absolutely correct, Abhi. Well done. 35 is the answer. So here, the premature encashment can be done by the senior citizen in the age between 60 to 70. Uh, the the lock-in period is 6 years, after which they can take out the money from the floating rate saving bond. Age 70 to 80, lock-in period is 5 years. Age 80 and above, lock-in period is 4 years. Okay. So for them, the lock-in period is not 7 years. For them, the lock-in period is 6, 5 or 4 years. Now, coming to the next question, under the RBI's reporting framework for authorized dealer category 1 banks, minimum reporting requirement to the trade repository of CCIL for the OTC over the counter Forex derivative contracts involving INR is at least what percentage from 1st January 2028 for the related parties other than the parent and its branches? So, it has been said that the authorized dealer category 1 banks for their related parties, they need to inform the OTC derivative contracts involving INR to the trade repository of CCIL. For the related parties that are the parents and its branches, 100% of reporting should start from 1st July 2027. But for the other related parties, the reporting should start, the 70% of reporting should be from 70% of the reporting 70% of the reporting should be from 1st July 2027, but 80% of the reporting should be like for related parties that are other than parent. Okay. So here the right answer is first of all 80% that we have. Yes. Absolutely correct, everyone. So basically, the idea is that authorized data category 1 bank, they have to gradually increase the reporting of the INR based Forex derivative transactions involving INR that is done by their related parties for the parent and its branches from 1st July 2027. As I have told you, 100% of reporting is compulsory from 1st July 2027. But for the related parties that are not the parent or not the branches of the parent, for that the minimum reporting requirement is 70% from 1st July 2027 and 80% from 1st January 2028 and 100% from 1st July 2028. Remember this, okay? Authorized dealer category 1 bank shall have the option to not report certain small transactions if their size is up to $1 million only. This is the idea. So for the parent, the reporting should happen from 100% of reporting should happen from 1st July 2027. For the related parties that are other than the parent and their branches, the reporting should be 70% from 1st July 2027, 80% from 1st January 2028, and 100% from 1st July 2028. Okay? Now, try to answer this question. Under the RBI Commercial Bank Undertaking of Financial Services Directions 2026, commercial banks have been granted relaxation from the Alternative Investment Fund investment norms in respect of which of the following? Anyone who is able to answer this question? See, under the alternate, see, regulated entities, they can invest individually they can invest 10%, like up to. Regulated entities, they cannot invest more than 10% in the alternative investment fund, in one alternative investment fund scheme. Regulated entities in aggregate combined, they cannot invest more than 20% in the alternative investment fund scheme. Okay. So in this case, what is the idea? That there are certain restrictions on the regulated entities investment that they can do in the alternative investment fund scheme. But there are such restrictions are not applicable on which of the following funds and such. So agri funds for startup and rural enterprises, that is agri, for the agri-share fund, this kind of restriction is not applicable. That is the idea. So RBI has specifically exempted the agri-share, that is agri fund for startups and rural enterprises. For this particular fund, the exemption is provided from the investment norms that are applicable to investment in alternative investment fund. So alternative investment fund, there are certain restrictions. So regulated entities, individually they cannot contribute more than 10% of the corpus of the alternative investment fund scheme, and aggregate contribution in an alternative investment fund scheme from the regulated entities cannot be more than 20% of the corpus. If regulated entity holds more than 5% in an alternative investment fund and the AIF subsequently invest in the borrower entity of the regulated entity, in this case the bank has to maintain, or the entity has to maintain, the provisions of 100%. Okay. If the if the bank or if the regulated entity is investing in the subordinated units of AIF, in this case these subordinated units investment should be deducted from the capital base, from the tier 1 and tier 2 capital. Now the agri share, RBI has now exempted agri share from the above requirements, from the above restrictions, as well as previously Swami investment fund was also provided similar exemption by the RBI previously. This is the idea. Now coming to the next question. As per the RBI framework, government securities are traded electronically through which of the following systems? Through the RTGS, NDSOM, NEFT, CCIL settlement system, NDS call. Through which of the following? Through which of the following the government securities are traded electronically, through which of the following system? Government securities are traded between the investors through NDSOM. That is negotiated dealing system, order matching. Okay? And recently it has been said that if a entity, if a bank, NBFC, pension fund, or the insurance company, if they want to have, if the entity want to have a direct access to the NDSOM, then the application has to be sent through which platform? Through Daksh platform, through Mitra platform, through Pravab platform. Through which platform the application has to be sent? Through Pravab platform. Okay? Through Prava. So this is the idea, that if an entity wants to have a direct access, if an entity wants to have a direct access to the NDSOM platform, then the application should be sent through the Prava platform. This is the update that came, and the rest is just the history or the master action that was released last year. So NDSOM is the electronic trading platform authorized by the RBI for trading in the government securities. This is an anonymous order matching system. Now NDSOM platform, to this you can have direct access, indirect access, or through the stock broker connect. Direct access is provided to banks or NBFCs, the insurance companies, pension funds that are the big financial entities that have the CGL account, SGL account, sorry, subsidiary general ledger account, in which the government securities can be maintained in the demat form with the RBI, as well as they have the current account for the purchase of the government securities. They have the current account through which the amount can be deducted. Okay. So direct access are provided to the big financial entities. Indirect access is provided through the entities that have the direct access. So the entities like the banks, NBFCs that have the direct access, they can provide the indirect access. Now, via stockbroker connect. So stockbrokers, if they want to provide the clients of the stockbroker the access to the NDSOM platform for the trading in the government securities, so the stockbrokers through the stockbroker connect, they can connect with the NDSOM platform, so that the stockbrokers, they can provide the access to the NDSOM to their clients. So this is the broad idea. You can read the rest. Whatever I have stated has been written here, that you can read. Okay. Now under the digital, sorry, under the Digital Payments E-Mandate Framework 2026, what is the threshold amount up to which payment of insurance premiums and subscription to the mutual funds can be executed without requiring AFA, additional factor authentication? So for the regular transactions, the limit is 15,000. But particularly for the insurance premium subscription to the mutual funds, for such kind of payments, the payments can happen, the recurring payments can happen without requiring additional factor authentication up to what limit? 1 lakh. Very good, very good. 1 lakh is the answer. Okay? Correct, Mayank. Very good. As per the Digital Payments E-Mandate Framework 2026, all recurring transactions may be authorized without additional factor authentication up to 15,000 per transaction. Transactions above this amount shall be subject to additional factor authentication. Payment of insurance premium, subscription to mutual fund, credit card bill payments may be made without additional factor authentication up to 1 lakh per transaction. Now, if you want to set up the e-mandate for the recurring payments, you need to do the one-time registration process. And whenever the amount has to be deducted, let's say on the monthly basis, the amount has to be deducted for your subscriptions, uh, for your subscriptions or SIPs and such. So pre-transaction notification you will get at least 24 hours before the actual debit. Okay. Pre-transaction notification is not required for the e-mandates used for auto replenishment of the FASTag and NCMC balances. Now, coming to the next question, try to answer this question. As per the RBI amendment direction on branch expansion norms for deposit taking NBFCs, nationwide branch expansion is permitted only if the net owned fund exceeds what? You will get the PDF in the Telegram channel. As per the RBI amendment directions on branch expansion norms for deposit taking NBFCs, including housing finance companies, nationwide branch expansion is permitted only if the net owned fund exceeds 50 crore and the credit rating is A or above. So net owned fund should be more than 50 crore and the credit rating should be A or above, so that the branches can be expanded anywhere in India, agents can be appointed anywhere in India. But if the net owned fund is up to 50 crore only, or the credit rating is below A, in any of these circumstances, only within the state where the registered office is located, only in that particular state, the branch in that particular state only the branches can be opened. Okay. Now, is the bank, sorry, is the NBFC allowed to open branches in the other countries? New branches, can they be opened in the in the foreign countries? No, it is not allowed. But the representative offices can be opened in the other countries. Okay. So NBFCs, they are generally permitted to open branches within India without prior approval of the Reserve Bank of India. So NBFCs, they are generally permitted to open branches without having need to open prior approval from RBI within India. Okay? But if they want to open branch abroad, that is not allowed. First of all, only those NBFCs which already had branches and had informed RBI earlier, they can continue them. No new branches are allowed. Now, if the NBFC wants to close its business or wants to close its branch, sorry, if it wants to close its branch or office, so NBFCs must give a 3 months public notice before closing any office or branch. If a deposit taking NBFC publishes such notice, if the deposit taking NBFC is publishing such notice, then RBI or the NHB has to be informed within 7 days of issuing such kind of notice. Okay, representative offices can be opened abroad, but it is only for the communication for the communication, for the cooperation, for the market studies, research, and such. The transactions cannot happen through the representative office. This is the idea. Now, as per the half yearly report on management of foreign exchange reserves released in April 2026, which of the following are excluded while calculating FCA, foreign currency asset? Anyone? So basically, see the FCA, the foreign currency asset. See, in the foreign exchange reserves, the RBI is holding the maximum percentage of the foreign exchange reserves in the foreign currency asset, in the dollars, euro, pound sterling, Japanese yen, and such. The government, sorry, the RBI is also holding gold in the foreign exchange reserves, SDRs, and the reserve tranche position. We have discussed in detail this half yearly report on the management of foreign exchange reserves. You can see the detailed session in the Finance 360 degree session. Okay. Now, the foreign exchange reserves, which are excluded from the foreign currency asset. The SDR holdings of RBI, they are excluded from the FCA because they are separately included. Okay. Investment in bonds issued by IIFC, that is India Infrastructure Finance Company UK. So these are also excluded. Amount lent under the Shark facility, under the Shark and the Asian Clearing Union currency swap arrangement. So if the amount is lent by the RBI under the Shark currency swap arrangement or Asia Clearing Union currency swap arrangement, so they are also excluded. RBI's contribution to funding of Nexus Global Payments, so this is also excluded. Deposits with commercial bank overseas, this is not excluded because the FCA is basically invested in the securities, especially the government securities like the sovereign government securities, or the securities that are backed by the sovereign government. The FCA is also deposited with the BIS or the commercial bank overseas and such. So the 1, 2, 3, and 4, they are excluded. C is the answer. Okay. Remember this. It was given in the half yearly report that the investment in bonds issued by IIFC, they are excluded while calculating FCA. SDR holdings, amount lent under Shark and the Asia Clearing Union currency swap arrangement, and RBI's contribution to funding of Nexus Global Payments so they are excluded. They are excluded. Okay. These are the four things or four categories that are excluded from the FCA calculation. The FCA includes securities, especially the sovereign securities, that is the government securities, the foreign government securities, or the securities backed by the foreign government. This is the major chunk where the FCA goes. Deposits with other central bank and BIS, Bank for International Settlement, and deposits with commercial bank overseas. Got it? Any confusion here? All of you gave the answers B only, but the answer here is C. Got it? Any confusion? Got it? Okay. Moving forward, as per the half yearly report on management of foreign exchange reserves, as per the half yearly report on management of foreign exchange reserves released in April 2026, the foreign exchange reserves increased by what in nominal terms, including valuation effect, for the period of April to December 2025? See, the foreign exchange reserves, they depend upon the balance of payment. Balance of payment, the trade that we are doing, the transactions that we are doing with the other countries. Okay? So the balance of payment was in deficit. The whole balance of payment, the current account, capital account, both the accounts were in deficit, due to which now the balance of payment is in deficit. That means we are doing more imports from the other countries and such, so we have to pay more. So foreign exchange reserves decreased because we had to pay more in dollars or in euro, we had to pay more. So there was balance of payment deficit of $30.8 billion. So balance of payment deficit was of $30.8 billion. This that means this is the reduction in the foreign exchange reserves, because we had to pay $30.8 billion extra to the other countries from our foreign exchange reserves. But the foreign exchange reserves improved because of the gold valuation, improvement in the gold value, because of the decrease in the value of dollars against the other currencies, like we are also holding euro, pound sterling, and the Japanese yen. So against the other currencies, the dollar value decreased and the bond prices improved. So due to all these reasons, the valuation increased of the foreign exchange reserves. The foreign exchange reserves valuation increased. There was increase in the valuation in the foreign exchange reserves because of the gold value increasing, because of the decrease in the value of the dollars against the other major currencies, and the bond prices increasing. So valuation effect on the foreign exchange reserves was $50.2 billion. That was in positive. So balance of payment deficit was there, but the valuation was in positive, and that's why in nominal terms the foreign exchange reserves have increased by $19.4 billion. This is something that is important. Okay, so this is all. Any confusion here? So balance of payment has decreased, but the valuation effect was in positive. So foreign exchange reserves decreased because of the balance of payment situation, but because of the valuation effect, the foreign exchange reserves increased, and there was the higher valuation effect of $50.2 billion that covered the deficit in balance of payment, and that led to the foreign exchange reserves increasing by $19.4 billion. Now, coming to the next question, try to answer this. As per the Reserve Bank of India, non-banking financial companies registration exemptions and framework for scale-based regulation amendment directions 2026, unregistered type 1 NBFCs should have asset size below what? So as I've told you that the NBFCs, they are divided into two types, type 1 and type 2. Type 1 NBFCs are such NBFCs that do not take the public funds, they do not have the customer interface. Type 2 NBFCs, they have the public, they take the public funds or they have the customer interface. Now, type 1 NBFCs are further divided into unregistered and the registered ones. Unregistered type 1 NBFCs are such type 1 NBFCs that have the asset size of less than 1000 crore. So the unregistered type 1 NBFCs are the NBFCs that have the asset size of less than 1000 crore. So C is the answer. Okay, this is very, very important that you have to remember. So type 1 NBFCs, they do not take the public funds, they do not have the customer interface, but if they are registered, they need to be registered if they have the asset size of 1000 crore or more than that. They need to have the certificate of registration then. Unregistered type 1 NBFCs, they do not have the public funds, they do not take the customer, they do not have the customer interface, but their asset size is less than 1000 crore, so they are exempted from the registration with the RBI, and they are provided the relaxation of not maintaining the reserves. Okay, type 2 NBFC, they have the public funds or they have the customer interface. So basically, deregistration window, if the type 1 NBFC has the asset size of less than 1000 crore, that means it needs to be the unregistered type 1 NBFC. So it does not need to maintain the reserve fund, it does not need to register with the RBI. So that is the idea. Now, if the type 1 NBFC, before the release of the guidelines, if the NBFC has the public fund, sorry, does not have the public fund, does not have the customer interface, it has the asset size of less than 1000 crore, if it is already registered with the RBI, then it needs to deregister by December 31st 2026. Okay, that's the idea. Chalo. Now, audited financials of the NBFC, if it wants to get unregistered because it is not taking the public funds, it is not having the customer interface, it has the less than 1000 crore of the asset size, so it wants to get deregistered. If it was previously registered and now it wants to get deregistered, so it needs to provide the audited financials of the NBFC for the last 3 years and the statement on the status of public funds and customer interface in the last 3 years. That is the idea. Overseas investment, unregistered type 1 NBFCs, if they want to invest overseas in the financial services sector, then they are allowed if they take the prior approval from the RBI and register as a type 1 NBFC. Now, coming to the next question, try to answer this question. As per the Reserve Bank of India's amendment directions on urban cooperative banks concentration risk management 2026, which of the following statements is or are incorrect? Advances against receivables shall be treated as secured advances only if such receivables originally have a tenure of not more than 90 days. The aggregate unsecured loans and advances granted by a urban cooperative bank shall not exceed 20% of its total loans and advances as per the audited balance sheet as on 31st March preceding financial year. RBI has removed the earlier fixed range of 0.25 lakh to 5 lakh per borrower for salary earner UCBs and prescribed now has prescribed slab-wise limits on unsecured advances based on UCBs, demand and time liabilities and net worth requirement. Try to answer this. What do you think? That out of the first, second and third statements, which of the following is correct or incorrect? Incorrect you have to find. So which is incorrect? Advances against receivables, that is the bills discounted or the trade receivables. So advances, the loan that is provided against the bills, shall be treated as secured advances only if such receivables only originally have a tenure of not more than 180 days. Okay, so this was wrong. Aggregate unsecured loans and advances that can be provided by a urban cooperative bank shall not exceed 20%. This is correct. RBI has removed the earlier fixed range of 0.25 lakh to 5 lakh. Now there is the prescribed slab-wise limits on unsecured advances that can be provided to a single borrower or a group borrower by the UCB, by the salary under UCB on the basis. Now the slabs are decided on the basis of demand and time liability and CRAR. That is the capital adequacy requirement or the capital adequacy ratio, not net worth. So this was also wrong. That's why the right answer here is 2 only. The incorrect is 1 and 3. 1 and 3. So remember that the slabs. See, the unsecured advances against receivables will be treated as secured advance only if such receivables originally have a tenure of not more than 180 days. Okay. Now, UCB can give unsecured loans and advances only up to 20% of its total loans and advances, and unsecured loans up to 50,000 per borrower if they are coming under the priority sector loans given by the UCB that has the eligibility criteria. So they will not be considered under the 20% ceiling. So unsecured loans and advances that can be provided by a UCB is 20%. Now, if the urban cooperative bank is providing 50,000 per borrower, up to 50,000 per borrower, and this loan is coming under priority sector loan, and the UCB has followed the eligibility criteria, it is a good, healthy urban cooperative bank, then these kind of loans, if they are unsecured loans that are provided for priority sector lending up to the limit of 50,000, they do not need to come under the unsecured loan limit of 20%. Now, ceiling on unsecured loans for the salary under UCBs, before for them there was a strict limit of 0.25 lakh to 5 lakh. There was a range that was given, but now there is the slab wise order limits that have been provided for the unsecured advances given by the salary under UCBs, and the slabs are decided on the basis of demand and time liabilities, that is the demand and time deposits, and the CRAR. I have taken a detailed session on this article also. So you can see the detailed session. I've given you the overview that now the slabs are decided for the salary under UCBs. If they are giving the unsecured loans to the individual borrowers or to the group borrowers, then for individual borrower or group borrower, there are the limits for the salary under UCBs according to the demand and time liability and the CRAR. Okay. Now the salary under UCBs, they need to maintain the CRAR of 9%. The salary under UCBs, anyone know that they come under which category of UCBs? Tier 1, Tier 2, Tier 3, Tier 4. They come under which tier? They come under Tier 1. Okay. Now coming to the next question. As per the RBI's amendment directions on concentration risk management for urban cooperative banks 2026, loans granted by a urban cooperative bank to nominal members for purchasing consumer durable items are capped at which of the following amounts? So nominal members are the members of the UCB that do not have much power. So usually the UCBs can only provide the loan to their members that have the shareholding in the UCB. Nominal members, they do not have the shareholding in the UCB. They have become the member just for a time period. They do not have the voting rights. They do not have any right in the. They do not have any right to attend the meetings and such also. Okay. So nominal members, they can take the loan from the UCB for purchasing consumer durable up to the limit of 2.5 lakh. This is the answer. So nominal members includes a person who is a co-partner, wants to stand surety, or wants to avail permitted credit facilities for a period not exceeding 3 years. Okay. Now they cannot attend the meetings, they cannot get the share certificate, they cannot get the annual report from UCB and such. They cannot attend the meetings or they cannot vote, but they can get the loans up to 2.5 lakh for the consumer durables and such. Coming to the next question, try to answer this question. This is also for the UCB's Credit Facilities Amendment Direction 2026. So as per the Reserve Bank of India, Urban Cooperative Banks Credit Facilities Amendment Direction 2026, which of the following limits are correct as per the category? So try to answer this. So for the different tiers, so the limit on the unsecured advances to a single borrower. Think about it. We discussed for the salary earner UCBs. For the salary earner UCBs that come under the tier 1, for them the maximum limit is 5 lakh. For them the maximum limit is 5 lakh, right? That means salary earner UCBs that come in tier 1, they have the maximum limit of 5 lakh for single borrower, for individual borrower, for the loan limit, for per loan limit. That means for tier 1 UCBs, the limit is 5 lakh, not 2 lakh. For the tier 2, the limit is 7.5 lakh. And for tier 3 and 4, the limit is 10 lakh. So only the correct is third one, that is tier 3 and 4. So as per the RBI Credit Facilities Amendment Direction, which of the following limits are correct as per the category? So tier 3 and 4, for them, it is correct. For tier 1, the limit for unsecured advances to a single borrower is 5 lakh. Tier 2, 7.5 lakh. Tier 3 and tier 4, 10 lakh. Okay? So this is what you have to remember. Now, coming to the next question. As per the RBI Urban Cooperative Banks Credit Facilities Amendment Directions 2026, issued in April 2026, what is the maximum tenure permitted for housing loans granted by tier 1 and tier 2 urban cooperative banks, including the moratorium period? So what is the maximum tenure for the housing loans, including any moratorium period, that is non-repayment period, that is provided during the construction of the house? So during the construction phase, the moratorium period can be provided. So including the moratorium period, the maximum housing loan can be given. The maximum tenure of the housing loan can be 20 years. Very good. So tier 1 and tier 2 UCBs, see, tier 1 UCBs are unit UCBs that are only present in one district. They do not have branches in the other district or another area. They are the salary earner UCBs. Irrespective of the deposit size, all other UCBs having deposits up to 100 crore. So they come under tier 1. Tier 2 UCBs are the bigger UCBs with deposit size of more than 100 crores but up to 1000 crores. Tier 3 UCBs, they have the deposit of more than 1000 crore but up to 10,000 crore. Tier 4 UCBs, they have the deposit of more than 10,000 crore. Okay. So tier 1 and tier 2 UCBs, they can provide a housing loan for up to 20 years, including the moratorium period. Now the moratorium period can be maximum provided for how many months? For 12 months, for 48 months, for 24 months, for 64 months. For how many months the moratorium period can be provided? The moratorium period can be maximum provided by the tier 1 and tier 2 UCBs for 24 months. Okay. Now coming to the next question, try to answer this question. Okay. As per the Reserve Bank of India's prudential norms, am I still clearly audible? So as per the Reserve Bank of India's prudential norms on declaration of dividend directions 2026, again we have discussed this in detail in Finance 360-degree session. So I will provide you an overview. So see, the banks, the local area banks, regional rural banks, small finance bank, commercial banks, they can declare the dividend. They can declare the dividend, but there are certain limits that how much dividend they can declare. The dividend that they can declare depend upon the adjusted profit after tax, that is adjusted net profit. So adjusted net profit is what? It is adjusted profit after tax. What is the adjusted profit after tax? What is the formula? That you have to tell me in the comment section. Now as per the RBI's prudential norms on declaration of dividend directions 2026, RRBs, regional rural banks and local area banks, they are not permitted to distribute dividends beyond what percentage of their reported profit after tax, irrespective of their bucket eligibility. So see, the banks, they can provide the dividend on the basis of their adjusted profit after tax, but the dividend cannot exceed 80% of the reported profit after tax, of the total profit after tax. Okay, for the local area banks and regional rural banks. So 80% is the answer here. Correct. So the adjusted profit after tax formula is adjusted profit after tax formula is profit after tax minus 50% of the net non-performing asset. 50% of net non-performing asset. So the dividends are paid on the basis of the adjusted profit after tax. So dividend is allowed as a percentage of the adjusted profit after tax on the basis of the bucket, That depends upon the different criterias. Regardless of the bucket limit, regardless of any other limit, the total dividend that is declared cannot exceed 75% of the profit after tax for the relevant period in the case of small finance bank and payment bank. Okay, so out of the total profit after tax, the maximum 75% can be provided as the dividend by the uh, by the by the small finance bank and the payment bank, and maximum 80% can be provided by the RRBs and local area banks. Okay. Now coming to the next question, that for the commercial banks, again, commercial banks, they have to provide the dividend, or they can provide the dividend from the adjusted profit after tax on the basis of the common equity tier 1 capital that they are maintaining. So commercial banks, on the basis of the common equity tier 1 capital that they are maintaining, they can pay the dividend from the adjusted profit after tax, but the dividend cannot exceed what percentage of the profit after tax? The dividend cannot exceed what percentage of the profit after tax? 75%. Okay, for the commercial banks, for the small finance banks, and for the payment banks. Remember that the 75% of the profit after tax is the limit. But for the local area banks and for the RRBs, the limit is 80% of the profit after tax. So this is the idea that the dividend is allowed as a percentage of the adjusted profit after tax. Adjusted profit after tax is the profit after tax minus 50% of the net NPA. Okay, so from the adjusted profit after tax, dividend is allowed as a percentage of adjusted profit after tax on the basis of the different buckets, on the basis of the common equity tier 1 capital that the commercial bank is maintaining, but the dividend cannot be paid more than 75% of the total profit after tax. This is the idea. Now coming to the next question, the Reserve Bank of India, under the Prudential Norms and Capital Adequacy Amendment Directions 2026, has prescribed different add-on factors for market-related off-balance sheet contracts having residual maturity of less than 1 year. Arrange the following contracts categories in ascending order, small to big, of their prescribed add-on factors. So we have discussed the add-on factors. Basically, uh, there is counterparty risk when the derivatives are being signed. So there are two parties, Bank A and Bank B. Now they have signed a derivative contract that in the future, the Bank A will provide $1 million at the rate of $1 equal to 100 rupees. Now, any of the party can default. So there is a counterparty risk. Counterparty risk means both the parties are at risk that any of the party can default. In this case, the derivative will be settled in a future date. So any of the party can default in any date. So there is the credit exposure that we want to see, the credit equivalent exposure of this derivative. So for that, we can see the current exposure plus the potential exposure. Potential exposure means current exposure. We know that right now what is the exposure. For the potential exposure, we take the notional value, multiply it with the add-on factor. Now add-on factor is decided by the RBI. Okay, add-on factor has been provided by the RBI. Notional value is the value of the derivative. So add-on factor, the minimum add-on factors are for the interest rate contracts. And the maximum add-on factor that I remember is for the precious metal contract. So if you can do the elimination method, 2 is the first, like the minimum is for interest rate contract, the maximum is for precious metal contract. So yes, this is the only option that can be correct, right? Remember it, that minimum is for the interest rate contracts, maximum is the is for the precious metal contract. So if you even remember the minimum and maximum, then also you will be able to answer the question as A. Okay, basically as here you can see credit exposure under the credit equivalent method, where we want to see the counterparty risk, where we want to see the counterparty risk for the derivative contracts, for the off-balance sheet contracts. So here we take the credit exposure under the credit exposure method, credit current exposure plus the potential exposure. Potential exposure is notional multiplied by add-on factor. Add-on factors are minimum for the interest rate contracts, maximum for the precious metal except gold. For the exchange rate contracts and gold after that. So minimum for the interest rate contracts, then for the exchange rate contracts, then for the equities, and at last for the precious metal. So this is how you can remember. Okay, this is how you can remember. Minimum for the interest rate contracts, then exchange rate contracts and gold, then equity contracts, and maximum for precious metal. Now, for payment bank, only the exposure on exchange rate contracts and gold are relevant. This is important point that you have to remember. As well as whenever there is, let's say there is the periodical reset that is happening. So periodical reset is allowed to zero. That means the contract is for 5 years, but after every 6 months, if the transaction is happening, if the settlement is happening, then the periodic reset is allowed. After 6 months, after 1 year, let's say the periodic reset is happening after 3 months or after 2 months, after 2 months or after 2 years, the periodic reset is happening. So whenever the periodic reset is happening, that is allowed. But in the interest rate contracts with total maturity over 1 year, more than 1 year, the add-on factor cannot be less than 0.50%. That you have to remember that even under the periodic reset, this is the clause that interest rate contract with total maturity of more than 1 year or over 1 year, the add-on factor cannot be less than 0.50%. Chalo. Now coming to the next question, that as per the RBI's prudential norms on capital adequacy directions 2026, a bank clears trades on behalf of its client through a qualified or qualifying central counterparty if the bank is legally obligated to compensate the clients for losses arising due to the failure of the qualified central counterparty. How is such exposure required to be treated for capital adequacy purposes? So it should attract no risk weight. It should attract a risk weight of 20%. It should be assigned the risk weight of the client, the risk weight of the client. It should attract a 5% risk weight. It should attract a 2% of the risk weight. What is the answer? It should attract a 2% of risk weight. Okay, so E is the answer here. So clearing member exposure, so banks can act as the clearing members that clear and settle the trade. In this case, there is client A, there is client B, or there is A and B, they are doing the transaction, and the bank has become the clearing member that has to settle the trade. What if client A defaults? The bank will still have to settle the trade with the client B, right? So in this case, the banks still have the exposure, and the same formula will be followed, that is add-on factor multiplied by the notional value for the potential exposure. So current exposure plus potential exposure for the counterparty risk. Same formula will go. Lekin, but in the case of the qualified central counterparty, when the qualified central counterparty is present, then there is the formula that is not used. Just 2% of the risk weight is applied for the bank that is doing its own transaction, or the bank that is the clearing member that is doing the transaction on behalf of the on behalf of the client. Okay, so basically, if the clients or if X and Y party, they are doing the derivative transaction, and the clearing member is the bank that has to clear and settle the trade. If let's say X fails, then also clearing member has to settle the trade, has to complete the trade, okay, with Y. So there is still the counterparty risk that what if the X fails, there is counterparty risk that what if the X fails, then the clearing member will have to settle the trade. So the clearing member will be under the risk category. So same formula will be used, that is the current exposure plus the potential exposure, the same formula will be used. But if there is a qualified central counterparty that is present, the bank is doing the trade for its own purpose, or the bank has certain client, or for the different parties the bank is clearing the trade, anyway the bank has to maintain 2% of the risk weight. That is the idea. Okay, now coming to the next question, under the foreign exchange management directions regulations 2026 issued by the Reserve Bank of India, submission of the currency declaration form is exempted when the aggregate value of foreign exchange brought into India remains within which of the following limits. So remember that if the foreign traveler, or if the traveler, or if the person resident in India from outside, if they are bringing dollars or euro or yen, so this money can be converted in the rupees, okay, without filling the currency declaration form, if the amount is up to till what limit? $10,000. Very good. Equivalent to $10,000. And if only, now this includes the traveler's check, this includes the notes and such. But what if only notes are coming? No traveler check, only cash, only cash. Then what is the limit of not filling the currency declaration form and converting these into rupees and such? So 5,000 is the limit. So a very small article this is. Basically, RBI has now inserted a standardized currency declaration form into the regulations. The currency declaration form is not required to be filled if the total foreign exchange that is brought into India does not exceed $10,000 involving the cash and the traveler's check and such kind of instruments that are brought. Uh, and the currency declaration form is not required if 5,000 rupees $5,000, sorry, is brought in the form of cash. Okay, and the value of foreign currency notes does not exceed 5,000. So basically, if the $10,000 or equivalent to that is brought in India, till then the currency declaration form need not be fulfilled, need not be filled if the money is coming in the form of traveler's check, other instruments, or cash. But the cash, the foreign currency notes should not increase or should not be above more than $5,000. Okay, the foreign currency note should not be exceeding $5,000. That is the idea. So currency declaration form is not required to be filled if the total foreign exchange that is brought into India does not exceed $10,000 or equivalent, and the value of the foreign currency notes does not exceed $5,000. Now try to answer this question. Anyone who is able to answer this question. So basically, which of the following statements regarding the legal entity identifier is or are correct? Legal entity identifier is a globally standardized 20 character alphanumeric identification code that identifies the entities, the financial entities that are involved in the financial transaction, or the entities that are involved in the financial transaction. LEI is used for identifying individual financial transactions. No, LEI is used to identify the entities that are engaged in the financial transaction. So LEI cannot identify the transaction. LEI identifies the entities. LEI identifies the entities. For entities undertaking non-derivative foreign exchange transaction, the LEI code shall be applicable only for transactions involving an amount USD 1 million or more. That is correct. For entities that are undertaking non-derivative foreign exchange transaction, the LEI code shall be applicable only for transactions that involve $1 million or more. Okay. So here the right answer is 3 only, because third statement was only correct, first and second are wrong. Chalo. So RBI has now consolidated as separate directions on LEI and UDI, and the master direction has been released. LEI code is not mandatory for all the non-individual entities. Sorry, LEI is mandatory for all the non-individual entities. That is for the companies, for the banks, for the institutions, for the non-individuals. For non-individuals means they are not individuals and they are entities. They are entities. So LEI is mandatory for the entities that are doing the over-the-counter transactions. That means they are doing the transaction in government securities, money market instruments. They are doing the borrowing and lending in the short-term duration period, foreign exchange instruments, and specified derivative products. In the case of non-individual entities, basically the entities, if they are undertaking non-derivative foreign exchange transaction, that is the foreign exchange transaction that is not derivative, then LEI code shall be required only where the transaction amount is equivalent to or exceed $1 million. Only then the LEI code will be required for the non-derivative foreign exchange transaction. All entities both in India and abroad undertaking the transactions covered under this direction must obtain an LEI code. So the LEI code is for entities. The LEI code has to be retrieved from the local operating unit, and the LEI code has to be provided for all the over-the-counter transactions that are happening under the RBI domain. So for the foreign exchange transactions, government securities transactions, for the money market instruments, for the over-the-counter transactions, that are the transactions not happening through the stock exchanges, not happening through the exchanges, for all the transactions that are not happening through exchanges that are under the domain of the RBI, LEI code is required for the entities that are undertaking such kind of transactions. Coming to the UTI, try to answer this now. With reference to the UTI framework under the master direction of RBI, unique identifiers in the financial market direction 2026, consider the following statements. UTI shall be generated for all the OTC transactions, including both derivative and non-derivative segments, Think about it, unique transaction identifier. So it identifies the transaction, that is correct. So that means UTI is for identifying the transaction. But what kind of transaction? The OTC derivative transactions, over the counter derivative transactions. These are the transactions that are not happening through exchanges. So the UTI shall be generated for OTC transactions, including derivative and non-derivative segment. No, it is only for the derivative. So this is incorrect. UTI consists of a maximum of 52 characters. Correct. It includes the 20 characters of LEI of the generating entity that is generating the UTI. Absolutely correct. In case of a transaction that is reported to the trade repository of CCIL without a UTI, so the CCIL is the one that the CCIL trade repository is the one that has to generate the UTI. Absolutely correct. So 2 and 3 is the correct answer. And the question is about incorrect. So 1 is the incorrect statement. So here the answer is D. Correct. So D is the incorrect statement. So UTI, unique transaction identifier, assigned to an OTC derivative transaction, shall be generated or reported for all transactions in the OTC derivative market. Okay. UTI should be 52 characters comprising of the legal entity identifier of the generating entity. So 20 characters will be of LEI and the rest will be the unique identifier. 32 more characters. So in total 52 characters for the UTI. Now the UTI shall be generated in accordance to the UTI technical guidance issued by the CPMI, that is the Committee on Payments and Market Infrastructure of BIS, Bank of International Settlement, and IOSCO. So IOSCO and CPMI, they have released the UTI technical guidance according to which the UTI should be released. Okay. Now the UTI generating entity. So UTI can be generated by any of these entities. First CCP, then like this is a waterfall. That first CCP, central counterparty, that is in between the two parties A and B are doing the derivative transaction. So the central counterparty, that is the third party, has to provide the UTI. But if it is not, then ETP, electronic trading platform through which the transaction is happening, or the entity that is mutually agreed. If they are not creating the UTI, then at last the CCIL trade repository. So in terms of waterfall, if a transaction is reported to the CCIL trade repository without the UTI, then the CCIL trade repository has to generate the UTI. The OTC derivative transaction, for them UTI is mandatory from 1st January 2027. And for all the derivative transactions that are over the counter derivative transaction, the UTI is mandatory. And the UTI has to be reported within 5 years, within 5 Mumbai business days uh, for the foreign transactions. Let's say the over-the-counter derivative transaction is happening between the Indian entity and the foreign entity, and the foreign entity is responsible for generating the UTI. So the Indian entity within 5 Mumbai business days have to report this UTI generated by the foreign entity. That is the idea. Now, coming to the next question, the Reserve Bank of India, while prescribing prudential limits for authorized dealer banks in domestic foreign exchange market, has fixed the maximum permissible net open position in INR at the end of the day at what? So basically, the authorized dealers, they buy the foreign exchange, they sell the foreign exchange. Let's say they have bought let's say they have bought $1 million. Let's say they have bought $1,000. Okay. They have sold $500 or they have sold $600. So they are left with $400. $400 million. So should they be allowed to hold so many of the dollars with themselves? No. That's why there is a limit that has been decided, that is $100 million. At the end of the day, a authorized dealer category 1 bank or the authorized dealer bank cannot hold more than $100 million. So they will have to sell the rest, that is 300 million or 350 million they have to sell, and only 150, 60, 70, 80, 90 million they can hold. So this is the idea that RBI has now decided that the authorized dealer banks must ensure that their net open position involving INR, that means they cannot hold more than USD 100 million. Okay, at the end of the business day, at the end of the each day, and this is applicable from April 2026. Now Payment Vision 2028 released by the RBI is built around which of the following themes? So these are the articles from March. So we are nearly towards the end of the March. Then we will see some of the like 2-4 questions we will see for the Jan and Feb important top 30 RBI notifications and press releases. that are included in that. Okay. So Payment Vision 2028 released by the RBI is built around which of the following themes? Anyone who remembers the theme of the Payment Vision? Anyone? Digital India Payments Revolution, inclusive digital finance for all, shaping India's payment frontier towards a cashless economy, secure and seamless digital transactions for all. C is the theme. Or the yes, C is the theme. Okay, shaping India's payment frontier. So Payment Vision document is important. At least the theme you should be able to remember, right? So see, Payment Vision 2028, RBI has been periodically preparing the Payment Vision since 2001. This includes providing strategic direction for the structured development of the payment and settlement system. RBI has released Payment Vision 2028 for the duration up to December 2028, where in this document 15 specific initiatives for the development of the payment domain has been notified for the next 3 years till December 2028. Payment Vision 2028 core theme is shaping India's payment frontier. Shaping India's payment frontier. So the Payment Vision 2028 is a strategic policy document released by RBI to outline the future roadmap for the payment and settlement ecosystem development. This document is specifically released by Department of Payment and Settlement System. Now, with reference to key developments in India's payment ecosystem, match the following. Such kind of questions we have seen in the phase one in the previous years. If you know, you know, otherwise leave these kind of question. Always remember in the examination, you have to see 80 questions in the limited time. So if the questions are very, very lengthy, you are not able to read it in a fast manner, or you think that these questions are complicated, shift to the next question, because there are many one-liner questions that you will be seeing. If you are not factually if you are not able to remember factually, do not waste your time here. See this question: payment and settlement system, do you know it was released in 2007, NPCI 2008? So you can use the elimination method. This is this, and payment and settlement system is 2007. So 2 ka 1, 2 ka A, 2 ka A, so either A or B. Now 4 ka D. So this is the answer. So if you are not able to remember for the Department of Payment and Settlement System and Trade Receivables Discounting System, do not worry about it. Use your elimination method. And remember 80 questions in the limited time. So you have to go in a faster manner. If you see some very complicated questions, which you just read the question and you see that, okay, you are not able to solve it in within 30 seconds, within 1 minute. So shift to the next question, move forward. If you are not able to answer 10 questions, do not worry about it. The later on questions will be easier. Think about this. Okay, if you're not able to answer 20 questions also, no worries. You have to focus on those 40 questions that you are able to answer. Do not, in the examination, do not let your confidence go down, because that will be the thing that will harm you in the examination. Okay, so even in the starting 5 6 questions, no worries. 10 questions, no worries. Go after that. You will be able to attempt the questions after that. Okay, have confidence on your preparation. Now, Department of Payment and Settlement System, it was 2005. So 1 का C, ठीक है. Payment and Settlement System Act 2007. So 2 का A. Trade Receivables Discounting System 2017. So 3 का B. And NPCI 2008. Now, this actually this kind of like the Department of Payment and Settlement System created within RBI 2005, Payment and Settlement System Act 2007, PSS regulations 2008. Okay, RTGS launched in 2004 and such. So basically, trade receivables discounting system became operational around 2017, but TREDS was launched by RBI in 2016 to help MSMEs. Um, but the 2017, the first TREDS platform started operating. So basically, TREDS. See, in the TREDS case, there are multiple years that have been given: 2017, 2014, 2016, and such. So you have to use the elimination method in such kind of cases where the years have been given, or you will have to leave it, because so many of the years, the past data, you will not be able to remember. Now, coming to the next question. Recently, the RBI published the Utkarsh 2029, another very, very important document of RBI framework comprising 6 strategy pillars. Which of the following best represents the vision statement of Utkarsh 2029? So, what is the vision statement of Utkarsh 29? So, there are there are values that are given under the Utkarsh 2029. See, Utkarsh 2029, it is the medium term strategy framework for the Reserve Bank of India. that informs about the values, about the strategic pillars, the strategic focus areas of the RBI. It provides the vision of the RBI. So you need to remember the vision of RBI, right? That is provided under the Utkarsh 2029. It is, yes, to continue excellence while enabling a stable, inclusive, and technologically robust financial system. So B is the answer. So RBI had first formulated its medium-term strategy framework, Utkarsh 2022, in July 2019, replacing its annual action plans with a medium-term strategy framework for a period of 3 years. Continuing the previous two frameworks, the RBI has launched Utkarsh 2029, okay, for a 3-year time period from financial year 2026 to 2029. Now, the structure of Utkarsh 2029, so there is the vision. That is the vision statement of Utkarsh 2029 is continue excellence while enabling a stable, inclusive, and technologically robust financial system. Following this vision, there are six strategy pillars. Under the six strategy pillars, there are 49 deliverables. And the values also, the vision and value, they both support the six strategic pillars. Now, coming to the next question, match the following strategic pillars with their respective focus area. So, the strategy pillars of the RBI, they show the focus area of RBI. So, use your logic. Even if you are not able to remember the focus areas for the strategic pillars, use your logic. Think about it that in 30 seconds, will you be able to answer this question? Robust regulation, innovation, cybersecurity, financial deepening, digitization, accessibility, interconnectedness, simplification, and resilience. Regulations should be simplified and resilient. A ka 4. Customer centricity and inclusive finance. So, innovation, cybersecurity, maybe financial deepening, digitization, accessibility, and interconnectedness. This seems like better, na? Customer centricity and inclusive. So, interconnectedness, accessibility, yes. B ka 3. Competitive market will come through innovation, cybersecurity, financial deepening, and digitization. So effective technology will be more linked to innovation and cybersecurity. So D ka 1 and C ka competitive markets will come through financial deepening and digitization. So C ka 2. ठीक है? Shubham, if you have started preparation, if you have started this journey, then just 10 days before or 15 days before the examination, now you cannot have the cold feet. Like, give your wholehearted attempt, and whatever happens happens. Then if you have started this journey, if you have given your 40-50 days, you have given your 1 month or something, so now you should not get the cold feet, right? Because you have already put in so much of the efforts. Now you will only waste your time in getting cold feet. Is the answer. Strategic pillars, robust regulations, robust, simplified, and resilient. Customer centricity, accessibility, and interconnectedness. Competitive markets, financial deepening, and digitization. Effective technology, innovation, cybersecurity. Future ready organization. RBI should be a future ready organization. So, upskilling of its employees. So, if you join the RBI Grade B examination, if you clear the RBI Grade B examination, you join the entity. So, there will be upskilling, and the focus is on sustainability, global India, standardization, and internationalization. There are 49 deliverables under the six strategic pillars. Under the six strategic pillars, there are 49 deliverables. The values are, see, what are the values according to which RBI performs or RBI works as per the values of public interest: integrity and independence, responsiveness and innovation, diversity and inclusiveness, introspection and pursuit of excellence. Okay? Try to answer this question now. Now we have complete, like we have done till March. Now these are the like there are only 4 questions left. So these will be the questions from Jan and Feb. From the most important articles of Jan and Feb. From the most important articles of Jan and Feb. Like the risk-based premium framework that is released by DICGC, internal ombudsman framework, and the priority sector lending updates that have come. So only three, I think three guidelines that are very important from the, and the digital payment index. So 4 guidelines that are very important from Jan and Feb. So that I've brought the questions from. Okay. So, based on the comprehensive review, DICGC has, with the approval of RBI, decided to implement a risk-based premium framework with effect from April 1, 2026. So, which of the following statements is or are incorrect in regards to the differential premium rate? So, local area banks and payment bank will continue to pay the card rate. Yes, absolutely correct. They will continue to pay the card rate of 12 paise per 100 rupees. So, basically, DICGC provides insurance to the depositors which are depositing the money in the banks. Now the banks have to provide the insurance premium to DICGC. Till now, all the banks, they were providing the flat rate of 12 paise per 100 rupees. Now it has been said that on the basis of the risk, the bank should provide their premium. The more risky bank should provide more premium, less risky bank should provide less premium. Okay? So local area bank, payment banks, they will still have to follow the flat card rate of 12 paise per 100 rupees. Based on the risk assessment score, how risky the bank is or how safe the bank is, on the basis of the riskiness, and the risk assessment score obtained by the DICGC, each bank will be categorized into 4 groups: A, Category B, Category C, Category D. So category A will be the safest banks that will have the discount of 33.33%. So basically, category A banks will get the discount of 33.33% on the card rate of 12 paise per 100 rupees. Vintage incentive. There is also vintage incentive. The banks that are old, they have been contributing to the DICCs for a long period of time, but they have never had the restructuring, or they are very secure bank that never needed to take the help of the DICCC. So vintage incentive for tier 1 banks. Tier 1 banks are the commercial banks excluding the RRBs. So tier 1 banks are the commercial banks and the small finance bank excluding RRBs. Vintage incentive for tier 1 banks is 1% premium discount for each completed year with a maximum of 25% discount. So 2 and 3 both are wrong, and that's why the right answer is B. Very good, everyone. So basically, the banks are divided on the basis of their riskiness or less riskiness or safe. So the more risky the bank is, the lower the category it is in. The safer the bank is, the higher the category the bank is in. Okay. So before, under DICGC, the banks had to pay a flat rate of 12 paise per 100 rupees of the deposits. Now DICGC has said that on the basis of the risk, the banks need to provide the premium. Okay. So category A banks, the safest banks, will get a discount of 33.33%. Category banks will get the discount of 16.67%. Category C will get the discount of 8.33%. Category D will get the discount of 0%. So the safest banks in the category A will get the highest discount of 33.33%. As well as on the basis of vintage incentive, there is also vintage incentive for the banks that have been working for a long period of time with a clean track record. So tier 1 banks, commercial banks, excluding the RRBs, excluding the RRBs and the small finance banks, commercial banks and the small finance bank that come in tier 1, they get 1% premium discount for each completed year, maximum up to 25%. Tier 2 banks, that is RRBs, state cooperative banks, district, central cooperative banks, tier 4 corporate, urban cooperative banks, they will get a 25% discount, uh, flat 25% of discount if they have been working for 25 years or more. Now, coming to the next question, see, such a question has come in the last year also. So basically, RBI releases the digital payment index on the half yearly basis, and the digital payment index, it shows the digitization, the penetration, and the deepening of the digital payments. So digital payment index basically shows the digitization that has happened in the country, the penetration and the deepening of digital payments. Now, digital payment index, it has the base year as March 2018, and the digital payment index depends upon 5 parameters. Now, all of these parameters, they have some subparameters. Now, which of the following subparameters belongs to the payment enablers parameter in RBI's digital payment index? Try to answer this. Let's see how many of you are aware about it. From the digital payment index last year, there were 2 questions in the phase 1. In the, yes, there were around 2 questions. So which of the following subparameters belong to the payment enablers parameter? So basically QR codes. This is payment infrastructure supply side. Debit cards, payment infrastructure demand side, because consumers have it. Complaints, this is consumer centricity. POS terminals, payment infrastructure supply side. Internet, this is payment enablers. So payment enablers, they enable the payment. Merchants, customers, internet, Aadhaar card, sorry, Aadhaar, yes, Aadhaar card that you have. So they are payment enablers. So basically 5 parameters are payment enablers: payment infrastructure demand side, payment infrastructure supply side, payment performance, and consumer centricity. Payment performance has highest weightage. Payment enablers, they are the internet, mobile, Aadhaar, your Aadhaar card, bank account, participants that and the merchants. Payment infrastructure demand side. On the demand side, we have the credit card, debit card, we have the prepaid payment instruments like the digital wallets, we have the fast tag, internet banking, and such. Supply side, the suppliers have the bank branches, like the bank branches, business correspondents that are the agents of the bank, ATMs, POS terminals, QR codes, intermediaries. Payment performance. How can you see the performance of the digital payments? By seeing the volume of the digital payments, the number of transactions through the digital payments, or the value of the digital payments, the new users for the digital transactions. Paper clearing has reduced, the check clearance has reduced and such, and more transactions are happening through the digital method. Currency in circulation has reduced as there are more transactions through the digital method. Cash withdrawals have reduced as there are more transactions through the digital method. So payment performance has improved. Consumer centricity, complaints have declined. There are less complaints, or the complaints or the customers have increased, so the number of complaints are being resolved in a better manner, but they have increased because the customers are becoming more aware. That can also be possible. Awareness and education declines, complaints, frauds, and system downtime. This shows the consumer centricity and the consumer awareness and education. Now RBI DPI has been released in, I think it was released in Feb or Jan or Feb. Okay, so it was released for the September 2025. It was released for September 2025. Maybe in Jan it was released. So it was released for September 2025. The index for September 2025 was 516.76. The base year for digital payment index is March 2018, for which the value was 100. Now in September 2025, the value was 516.76. That means there is huge increase in the there is huge increase in the value of the digital payment index. Okay, it was released in Feb. Okay, now you don't have to remember it, you just have to understand the concept. Even I don't remember the parameters, but I understand that QR codes to supply side, debit card demand side, complaints consumer centricity, POS terminal supply side. So understand it. Now why are you doing rectification in this particular case? If you understand what are payment enablers, what is payment infrastructure demand side, you should be able to answer the question. Okay, just focus on understanding, do not do rectification for this particular case, now basically digital payment index, it has improved, and for September 2025 the value of digital payment index was 516.76. It was released, this data was released in Feb 2026. Okay, now the digital payment index has become 516.76, and the digital payment index base year is March 2018. Why the digital payment index has improved in comparison from March 2025 to September 2025? The digital payment index has improved because of two factors, that is payment performance that has improved massively, and the payment enablers that have improved immensely. Okay, so digital payment index has improved from March 2025 to September 2025. The digital payment index has improved because of payment performance and payment enablers. Digital payment index, see Abhijit, because digital payment index is a very very important index of the RBI, so I have provided you the static, only this much you have to read. Okay, so it will be better that if you read it, even though it was released in Feb, but digital payment index is something that RBI has asked the question every year. In 2024, 2025 there were questions, so I have brought it for you. uh, just have the basic idea that I've provided here. RBI has recently issued the PSL target and classification directions 2026. These were issued again, they were issued in Jan. This was issued in Jan. The priority sector lending amendment directions, if you are able to remember it, fine. If you are not, then leave it. If you are leaving the articles from Jan and Feb, then leave it. Okay. RBI has relaxed the PSL target for small finance bank from 75% to what percentage? So basically, all the banks, they have the target under the priority sector lending to provide the loans to agriculture, micro, small and medium enterprise, export, education, housing, to provide the loans for the renewable infrastructure, the renewable energy, social infrastructure and such. So the small finance bank, they had the target of 75%, that has been reduced to 60%. So this is the answer. Okay. So total priority sector For the small finance bank, the total priority sector target, the priority sector lending target has been reduced from 75% to 60%. Now, urban cooperative banks can give priority sector loan up to 12 crore per borrower to build healthcare facilities in a city with population of less than 1 lakh. Beneficiaries under the National Urban Livelihood Mission have been excluded from the weaker section category. If a bank lends to NHB approved housing finance company, which is further lending for the purchase, construction, reconstruction of individual dwelling units or for slum clearance and rehabilitation. So for this particular case, these loans will be considered under priority sector loans up to the limit of 20 lakh per borrower. If commercial bank sanctions a loan to the National Cooperative Development Corporation on or after January 2026 and the NCDC, National Cooperative Development Corporation, further lends to cooperative societies for the agriculture purposes, for the MSME purposes. So these loans can be classified as PSL, but such loans given to NCDC for further lending for agriculture MSME purposes can only be classified as PSL till up to 5% of the PSL, up to 5% of the total PSL. Coming to the last second question. So recently, RBI issued the Internal Ombudsman Directions 2026. Even though last year the Internal Ombudsman Directions were not in news, they were 9 months prior to the examination. Still, a question came from the Internal Ombudsman Direction. So that's why I have provided the question here also, so that you know about the new directions for the Internal Ombudsman. Okay? Which of the following statement is incorrect that you have to tell? अच्छा अभिजीत, you were asking for the, अच्छा मुझे लगा कि पुराना data you are asking. March DPI, yes, it will be released after the examination. Okay, the directions are applicable on commercial banks, whether Indian or foreign, payment bank, small finance bank with 10 or more banking outlets. Absolutely correct. The directions are applicable for non-deposit taking NBFCs with asset size equal to or more than 5,000 crore. So see, internal ombudsman, which entities have to have the internal ombudsman? So commercial banks, payment banks, small finance bank, if they have the branches of 10 or more banking outlets, they have. NBFCs, a non-deposit taking NBFC with asset size equal to or more than 5,000 crore and having the public interface, customer interface, they have to maintain the internal ombudsman. So it should be 5,000. The tenure of internal ombudsman should be at least 3 years, but cannot exceed 5 years, including extensions. Credit information companies, they need to forward complaint to internal ombudsman. See, internal ombudsman, see, regulated entities, the banks, NBFCs, they get the complaint, they have to resolve the complaint. If they are partially rejecting some complaint or they are fully rejecting a complaint, then before completely rejecting the complaint or before partially rejecting the complaint and sending the uh, response to the customer or to the complainant, first these complaints go to internal ombudsman. So internal ombudsman only reviews such complaint that is partially rejected or fully rejected by the regulated entity that has hired this internal ombudsman. So internal ombudsman is the internal ombudsman of the regulated entity that has hired it. So it will review the partially rejected or fully rejected complaints, and if they are uh, correctly rejected, so that is fine. Within 30 days, the complainant should be given the response. Even after the review of the internal ombudsman, within 30 days, the process should be completed. Okay. So regulated entity shall ensure that the final decision of the internal ombudsman, deputy internal ombudsman, the final decision or final response to the complainant should go within 30 days. So all the other are correct. Only B was wrong. So basically, internal ombudsman directions, internal ombudsman is hired by the regulated entity for reviewing the rejected complaints, fully rejected complaints or partially rejected complaints. Okay. Now, who should hire the internal ombudsman? So bank, commercial banks, payment banks, small finance bank that have 10 or more banking outlets, deposit taking NBFCs with 10 or more branches, non-deposit taking NBFCs with asset size of 5,000 crore or more than that, having the customer interface. NBFC that meets these criteria after 31st 2025, they will be covered. They need to have the internal ombudsman within 6 months. NBFC now, non-bank prepaid payment instrument like the Paytm, that is providing the prepaid payment instruments, the wallets, digital wallets. So if the PPIs with more than 1 crore instruments, so such non-bank PPIs, they need to have the internal ombudsman and such. Okay. Internal ombudsman, basically the important points are that the internal ombudsman need to have the experience of 7 years. Deputy internal ombudsman need to have the experience of 5 years. They cannot be above 70 years before finishing their tenure. The tenure of internal ombudsman and deputy internal ombudsman at least 3 years, which cannot exceed 5 years. At least 3 years, minimum 3 years, cannot exceed 5 years. Now, so commercial, small finance, payment bank, NBFC, non-bank prepaid payment instruments, issuers, they need to forward the complaint. So let's say the bank has received the complaint, they need to forward the partially rejected or fully rejected complaints to the internal ombudsman or deputy internal ombudsman within 20 days of receipt of such complaint, or at least 10 days, at least 10 days should be provided to the internal ombudsman to review the rejected or partially rejected, fully rejected or partially rejected complaint. So within 20 days, the banks and the other entities have to pass on the complaint to the internal ombudsman if it is rejected fully or partially, and 10 days should be provided to review for internal ombudsman. Credit information companies, they have to forward the complaint to internal ombudsman within 25 days of the receipt of the complaint. So whole process should be communicated to the complainant, and the final response has to be given to the complainant within a period of 30 days from the date of receipt of the complaint. Okay, this is the idea. Yes, complaint has to be forwarded. So this was your last question. Okay, this was your last question. Now I will provide you certain homework questions that you have to answer. Chalo. So let me summarize the important points I have marked. The experience is very important. The tenure is very important. The applicability criteria, very, very important. As well as the customer is sending the complaint 20 days. Like 20 days, forward the complaint to internal ombudsman, deputy internal ombudsman within 20 days of receipt of the complaint, and 10 days should be provided, at least 10 days should be provided for the review of the complaint. But in total, within 30 days, the response has to be sent to the complainant. Okay. For the credit information companies, they have to forward the complaint to the internal ombudsman, deputy internal ombudsman within 25 days of receipt of the complaint, and they do not have this 10-day wala clause. They do not have this other clause. And within 30 days for all the regulated entities, within 30 days, they have to respond to the complainant regarding their complaint. Now, coming to the question, these are the homework question that you have to answer in the comment section below. Question number 1, RBI issued the internal ombudsman directions. Internal ombudsman shall either be a retired or serving officer in the rank equivalent to general manager. They need to have a minimum experience of how many years? Okay. Option D, let me see. Credit information companies, for them there is a special clause, na? That is what I told you. Credit information companies need to forward complaint for review within 25 days of receipt of the complaint. This is the special clause for the credit information companies, na? Credit information companies, they need to forward the complaint to internal ombudsman, deputy internal ombudsman for review within 25 days. So see, again, for the commercial banks, small finance bank, payment bank, NBFCs, non-bank prepaid payment issuers, there is different clause that they need to forward the complaint to internal ombudsman, deputy internal ombudsman within 20 days of receipt of the complaint, at least 10 days to be provided for review of complaint in case where RBI, NPCI and card networks prescribed resolution timelines. So 20 days of receiving the complaint, the bank, NBFCs, they have to forward the complaint to the internal ombudsman or deputy internal ombudsman within 20 days of getting the complaint. Now, in case spatial timelines or resolution timelines have been defined by RBI, NPCI, or card networks, in this case, at least 10 days should be provided to the internal ombudsman or deputy internal ombudsman for review of the complaint. This is the clause for all the other entities. For credit information companies, they have to forward the complaint to the internal ombudsman or deputy internal ombudsman for review within 25 days of receipt of the complaint. This is a special clause that you have to remember. The regulated entity shall ensure that the final decision and the final response is provided to the complainant within 30 days. So what was the question? Now read the statements again. The directions are applicable to commercial banks, payment banks, small finance bank with 10 or more banking outlets in India. Correct. The directions are applicable for non-deposit taking NBFC with asset size equal to or more than 5,000 crore. So this is incorrect. Tenure of the IO should be at least 3 years, but cannot exceed 5 years. Credit information companies need to forward complaint to the internal ombudsman or deputy internal ombudsman for review within 20 days. For the other banks, NBFCs, All India Financial Institution, this is 20 days. Okay. Or in case the RBI, NPCI, the card networks, they have informed the resolution timelines. So 10 days should be provided for review. Okay. So this is the idea. So that is the clause for other categories. The regulated entity shall ensure that the final decision should be communicated within a period of 30 days from the receipt of the complaint. Now clear? Option D says 25 days. This is because of the credit information companies special clause. This is only for the credit information companies that the special clause has been added, and there is no other clause. Only this is the idea. Only this is the clause. For the banks, commercial banks and such, there are two different clauses. One is forwarding the complaint to the internal ombudsman, deputy internal ombudsman in the regular cases within 20 days, or in special, like resolution timeline has been informed by the RBI NPCI card network, so within 10 days has to be provided for review. Here the forward is not mentioned. 10 days has to be provided for the review. Now answer this first question. I hope you will be easily able to answer the question. That read the question carefully and try to answer this question. The internal ombudsman framework, the experience should be how much for internal ombudsman? An applicant at the time of commencement of business as an authorized dealer category 3 shall have a minimum positive net worth of how much and shall submit a certificate of this effect from its statutory auditor. So authorized dealer category 3, I have in the initial, like first question was about the authorized persons. So authorized dealer category 1, category 2, category 3, full-fledged money changers, there are some net worth requirement. So what is the net worth requirement of the authorized dealer category 3? Last is the homework question again. Ways and means advances limits are reviewed periodically in consultation between the RBI and the government. The RBI in consultation with the government has fixed the WMA limit at 2,50,000 crore for the first half of the financial year. The RBI may initiate the process for fresh market borrowing by the government of India when about how much of the WMA limit is utilized. Try to answer this question. Any confusion, anyone? So these are the three homework questions. Whoever gives the right answer in the comment section below, I will comment the reply in that. Okay. So you can see whichever comments are correct. Below that, I will reply that it is absolutely correct and such. Okay. So this is the first question, this is the second question, and this is the third question. Do try to give the right answer of the homework question in the comment section below. And you will get the PDF of the session. As today is Sunday, so the team is not working. So you will get the PDF by tomorrow, 12 p.m. in the Telegram channel of EduTap. Any confusion, anyone? Any question, anyone? Any question? I will wait for 2 minutes before closing the session. If there is any confusion, kindly ask me. So now these are the weekend marathon sessions. You will also have another marathon session that we are also planning, so that before the examination again, the more questions you solve, the better it is. So we will plan more marathons in the future, but right now the weekend marathons are going. Just before your examination there will be additional marathons, the detailed marathons, like with this was the top 30 RBI notification or RBI press releases, but in the detailed marathon we will also do the additional questions. Okay. If you really like the session, then you can comment down below and do tell me that out of the 50 questions, how many questions did you give the answer correctly? How many questions were you able to solve? Other than that, do give the right answer of the homework question. Now I will be closing. I can see that there is no question. So thank you.